system. Would you?
Good morning.
Yeah.
State Controller, Ms. Paquin.
Here.
Superintendent of Public Instruction, Mr. Johnson.
Here.
Ms. Yamamoto.
Here.
Mr. Tang.
Here.
Ms. Hendricks.
Here.
Mr. Kennedy.
Here.
Ms. Bradford.
Here.
Ms. Erden.
Here.
Mr. Gunning.
Here.
For the State Treasurer, Mr. Ruffino.
Present.
You have a quorum.
Thank you, Alex. First item of agenda is the approval of the committee agenda. Do I have That's true. That's correct. Yeah.
The CalSTRS board meetings are live web streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared. Since the March Teachers Retirement Board meeting, CalSTRS received 9 emails from members asking if the retirement is safe due to the collapse of Silicon Valley Bank, 4 emails from members and 3 communications from non-members stating disagreement with CalSTRS priorities for proxy season, and received 2 emails from members supporting our proxy season priorities. 7 emails requesting CalSTRS to divest from East African crude oil, 3,424 forum emails regarding climate-related shareholder resolutions at banks and insurance companies. Back to you, Chair.
Thank you. We have a motion and a second on the agenda, and the motion is with some flexibility, I take it. Thank you.
Yes, with flexibility.
All in favor, say aye.
Aye.
Thank you. Now we have public comment. Are there any people in the public that would like to make comments?
We do have some speakers in the queue. First, we will have Michael.
Whoa, okay. Good morning. Not Anthony Davis, but okay, let's see. Anyway, good morning, CalSTRS Investment Committee meeting members. My name is Michael Ring, and I work with the Service Employees International Union. It's good to see many familiar faces this morning. Hundreds of thousands of SEIU members participate in public and private pension fund plans across the U.S., Canada, and Puerto Rico. SEIU members very much appreciate the work of fiduciaries who steward employees and retirees' dollars to ensure retirement benefits will be paid. It is our firm belief that among the key investment issues that fiduciaries of pension plans manage are those of a systemic nature that are central to determining a fund's ability to pay benefits not only to current retirees, but to plan participants who may not access those benefits until 30 years from now. We know that CalSTRS has been a leader in analyzing, understanding, and managing systemic issues that generate risk and opportunity. So thank you to all of you here at CalSTRS who do that important work on behalf of the teachers of California. We wanted to share with you some insights regarding the intersection of systemic risk and opportunity issues in the commercial aviation industry. So you can consider this information as part of your investment due diligence and engagement process with major actors in this key sector of the economy. Among those key systemic risks that investors are increasingly focused on are those related to the workforce. To quote an article from early this week in Bloomberg, it's shaping up to be the season of the worker at annual company meetings. Investors have filed more than 140 shareholder resolutions this year, pressing companies to address employee-related issues. As we saw so clearly during the pandemic, workforce issues are central to the operations of the U.S. aviation system. It is a system that relies heavily on contracted airport service workers to keep airports safe and functioning even through a global pandemic, climate disasters, and busy travel seasons. Despite the essential services this workforce continues to provide, many airport service workers are raising concerns about being underpaid and underprotected. These include cleaners, wheelchair agents, baggage handlers, concessionaires, and security personnel, among others. We believe that the interest of these workers in ensuring they have fundamental workplace standards in place for their protection and success on the job is aligned with all industry stakeholders, including shareholders like CalSTRS who are invested in the aviation industry, so that and calling on the industry to establish a business model that is sustainable and successful. It's also worth noting, of course, that the workforce issues we are highlighting intersect with other systemic factors facing the aviation industry that may impact long-term investment performance, obviously including the need for the industry to effectively navigate the energy transition to align with the goals of the Paris Climate Agreement. We will continue to provide relevant information to your staff team as it becomes available, and shortly you will hear remarks from my colleague Kevin Orange, an SEIU USWW member who works at Los Angeles International Airport, to provide you with further insight on these issues. Thank you for the opportunity to share this information today.
Thank you.
Thank you for your comment. Our next speaker will be Kevin.
Good morning. My name is Kevin Orange. I'm a LAX ramp agent at LAX, also executive board member at SEIU, USWW. I'm here to tell you about two main issues in our industry, our aviation industry, and where it poses a risk to investors. The first issue is poverty jobs for contract airline workers like me. We perform essential services for airlines. We are wheelchair agents, janitorial cabin cleaners, and security officers, and baggage handlers as myself. At LAX and SFO, we have, we work hard. We work hard to do the essential needs for, passengers, airlines, and the aircraft. But with high costs of housing and healthcare in California, we are still struggling. We have to get back to, trying to change this law, the living wage ordinance in LA. At LA right now, we have a campaign going for $25 an hour, plus health insurance, and family health care. I also myself, I don't have health care. I have dental bills. Dental is pretty expensive, so I had to put it on a credit card. Right now, I'm paying off the credit card expenses. At other airports across California and the country, workers have non-union, so they don't have protection. We've talked to Congress to introduce the Good Jobs for Good Job Airports Act to set standards across the nation for airport workers. Airline contractor workers are often paid little, so they struggle to make ends meet, like essential needs at home and so forth and so on. And the second liability here is the climate change. We're also doing a campaign for climate and pollution. Some of the workers stay in areas where pollution is, right by the pathway. We're working on with the city and the state to regulate that. That's a big concern for our employees, our family, and our friends. So we just I'm here just to reach out to, to ask for your commitment to help us, tackle some of these changes with our state level and also on our national level. Thank you.
Thank you for your comment. Our next speaker will be Alyssa.
Good morning, Chair and members of the board. My name is Alyssa Giacchino with the Private Equity Stakeholder Project. The Carlyle Group has invested billions in fossil fuel assets, which have dumped at least 277 million metric tons of carbon dioxide and other greenhouse gases into the atmosphere from 2011 to 2021, contributing to the global climate crisis and harming low-income communities and communities of color on a disproportionate basis. CalSTRS has committed over $900 million in recent Carlyle funds, including Carlyle Partners 7 in 2018, as well as the last Asia and Europe funds. Carlyle is seeking commitments for successor funds in each of these strategies and may approach CalSTRS for new investments. As of this morning's Q1 earnings call, Carlyle continues to struggle with fundraising. Carlyle stands out among private equity firms as having one of the largest energy portfolios, with approximately $22 billion in carbon-based energy. By comparison, Carlyle has committed just $1.4 billion to renewables, less than 1% of assets under management. These are the findings in a new report by Americans for Financial Reform, the Global Energy Monitor, and Private Equity Stakeholder Project. We have shared the report electronically. This report provides previously unavailable data that can serve as a resource for investors like CalSTRS. Given the industry's intrinsic opacity, the report's findings likely understate the extent of Carlyle's carbon footprint. With Carlyle's new CEO at the helm, the firm has the opportunity to redefine its direction on energy and adapt its investment strategy to align with the UN IPCC's recommendations. Key findings in the report include Carlyle is one of the largest owners of gas-fired power capacity in the U.S., rivaling giants like Berkshire Hathaway Energy and the Tennessee Valley Authority. Pollution from Carlyle's current fossil fuel burning power plants is emitted overwhelmingly in communities where residents of color and our low-income residents live in higher concentrations. Close to half of Carlyle's fossil fuel power plants have a record of environmental violations under its ownership. Carlyle has also held a majority stake in NGP Energy Capital since 2012, a firm that primarily invests in oil and gas. Carlyle collects over half of NGP's fee revenues and other income streams, while also identifying NGP as its main vehicle for carbon-based energy investments in the U.S. Carlyle has the responsibility to be transparent with its investors and the public about the impacts and risks in its energy portfolio. Before committing new capital, CalSTRS should ask Carlyle to disclose all energy investments and environmental impacts, including scopes 1, 2, and 3, and as well as how it will align its full portfolio with a 1.5-degree pathway. Thank you.
Thank you for your comment. Our next speaker will be Jason.
Hello, CalSTRS board members and staff. Thanks for your work. My name is Jason Opeña-Disterhoft with Majority Action, a nonprofit that supports institutional investors to mitigate systemic risks to investment portfolios through proxy voting. CalSTRS has been a leader in recognizing that climate change threatens the fund's mission of paying benefits to plan participants. And we applaud CalSTRS' commitment to cut portfolio emissions in half by 2030 and reduce them to net zero by 2050 at the latest. One of the most powerful tools to achieve these commitments is voting to hold board directors accountable at climate laggard companies. So plan participants should be glad to see the leadership steps CalSTRS has taken on this score. Climate Action 100 Plus is the largest investor initiative for ensuring that major emitters reduce emissions. CalSTRS has long played a leadership role, including engaging directly with key companies. As we documented in our report on CA 100 Plus voting in 2022, CalSTRS came in number 10 out of 73 major investors in terms of holding board members accountable at out-of-alignment target companies. It also held more directors accountable in 2022 than in 2021. We wanted to note two opportunities for CalSTRS to build on its leadership in the coming weeks and months. First, in this proxy season, one key group of companies is coming up for a vote. 2023 marks 5 full years since the history-making UN report on the importance of reaching net zero emissions by 2050, yet some carbon-intensive companies have still not committed to net zero. These include Marathon Petroleum, Berkshire Hathaway, Valero, Kinder Morgan, Phillips 66, and Chevron. Last week, CalSTRS took the important step of voting to hold one director accountable at Marathon, and we urge CalSTRS to likewise vote to hold directors accountable at the remaining companies without net zero commitments, with 4 of the 5 annual meetings happening in the next 5 days. Second, one of the great strengths of CalSTRS policy on climate director accountability is setting out very clear criteria. CalSTRS expects key companies to have either a net zero by 2050 commitment or a 2030 emissions target, either one or the other. These are crucial steps, but they are both crucial steps for mitigating climate risk, and they are both crucial for CalSTRS' goal of cutting portfolio emissions in half by 2030 and reaching net zero emissions by 2050. So going forward, we urge CalSTRS to make clear that it expects portfolio companies to have both a net zero by 2050 commitment and a commitment to cut emissions by 2030. We thank CalSTARS for its work in this area and urge the fund to continue to build on its leadership in the coming weeks and months. Thank you.
Thank you for your comment. That is the conclusion of public comments for item 2.
Or make a comment? Harry?
Thanks, Bill.
The mic's.
There it is. Okay, thank you very much, Mr. Chairman. I did want to ask staff, and I apologize for not giving you a heads up in advance, and I'm sensitive to the fact that this is not agendized, so we cannot have a discussion, and I'm also aware of the fact that some of these issues are specific to closed session discussions, but I would like for the staff, at least in a general way, to reassure the public that one of the issues that was raised to all of us at our recent investment committee meeting had to do with a child labor issue. And we have, as a board, as an investment committee, have heard about your communications. But if someone on the team could just explain to the audience and to the public how our team is communicating with our GPs when these issues are raised. So there's a clarity and transparency that these issues are followed up on.
We're all looking at volunteers. I'm going to go first.
Please.
Chris Sale, I'm the Chief Investment Officer for the fund. We're all over at Harry. We immediately reached out to Blackstone and to, when the 60 Minutes report came out and then the information came out, we've had lengthy discussions and dialogues. There's no excuse. The tolerance is zero, obviously, in this situation. They've explained, the number versus all the workers employed is small, but that's any more than one is unacceptable. And then I just learned yesterday that they found underage workers at McDonald's. As far as we can tell, those are franchises, not ownership. But then there again, we're going to hold companies accountable on that issue without question.
Thanks very much.
And we have for the public's sake, zero tolerance for child labor violations.
Thanks very much. And the other issues, as the chairman has spoken about, when they are brought to our attention, there is a communication loop that goes between the investment committee and our staff, and that is the channel for communications. And we wanted to reassure people that advocate at the microphone here that there is a process that we follow to ensure that your concerns are followed up on. So thank you very much. Thank you, Christopher.
And thank you, staff, for your aggressive and very quick attention to this matter because it came up at our last meeting, and I appreciate it, and I know the public appreciates it. The next item on our agenda is item number 3, the ALM study discussion, and I think it's Geraldine Jimenez's show.
Yeah, as Geraldine comes up, I'm not going to intro and steal any thunder. I'm just going to explain that Josh Diedish is not here. Unfortunately, he tested positive at the start of the week, so he has to quarantine all week. But he's watching and getting better. And
So much for secret.
I'll have Geraldine introduce the team so you know we'll make room up here. But
So much for privacy and secret.
Geraldine Jimenez, Senior Investment Director of Public Markets. I'm here today to talk about the asset liability management, though. And I did want to take this opportunity. Unfortunately, Josh wasn't able to join us, but I bet he's watching, and he spent a lot of time on this study. But I wanted to take the opportunity to introduce Anthony Schmidt. So we do have a deeper team than Josh. Anthony's been doing a lot of the behind-the-scenes modeling and working with our actuaries. So I thought it was a great opportunity to introduce Anthony, and he will answer any tough quantitative questions you have. And then you'll also see a lot of analysis by Makita. And if you recall, the study started in October where we discussed various risks. Makita's team did the modeling of those risks, so the geopolitical, the carbon future risks. So they will go into that. Where's the clicker? Oh, there it is. So I'm going to give you a high level. We followed up from March. In March, the investment committee gave us parameters saying bring back approximately a risk return profile of what we currently have. So we have done that. We've given you 4 options. We leaned in and actually recommended one options, but it's definitely up for discussion. I'll tell you why we recommended those options. But again, we look forward to questions for you. I will mention, though, and you heard this yesterday in the actuarial presentation, previously we did invest different programs differently with the cash balance plan invested separately. This study has included all of your programs, assuming we would invest them alongside one another. So if you approve this today, it would include that change. So just be aware of that. It's a big change for that program. But we think it's reasonable and we feel comfortable with that recommendation. So again, we did lean into one. You'll see it as option A. We think it improves diversification. It keeps our risk profile slightly lower, which is good. It lets us lean into the collaborative model, so a little more in private assets. It lets us have room to invest in the low carbon future, which is also a major initiative. I'm going to give you, this is actually your table 2, which has a lot of numbers in it, but this is pretty simple. If it's green, it's good, red, bad. So you can see option A, keeping our expected returns same or reducing the volatility. And also because our returns staying the same, it actually is providing improvements on the liability side. So you see lots of green there if you see probability of full funding. So that's a good thing. And notice the contribution rates, it's holding them steady. There was conversations yesterday about contribution rates for different groups. So it's holding it steady, the recommended portfolio. Whereas option B and C, some of those are lower risk and lower return, and that would put perhaps some risk at contribution rates holding them steady. So for these reasons, we had option A recommended. And then here it is. Here's the portfolio. You'll see we would be recommending moving out of global equity, 4%, and then into private equity, inflation sensitive, and in particular, inflation sensitive, we're seeing a lot of opportunities in the infrastructure space for the low carbon future and investing there. And then fixed income, it is that private credit direct lending. That's really what that increases. And so here's the recommendation. From here, I want to hand it over to Makita, though, because so they've taken this portfolio and the other ones and did some modeling. So we'll have them walk through their slides. And we probably need to pull up their slides.
I'll give just a moment for the slides to come up. I'm Mika Malone with Makita Investment Group. It's good to see you all. Here we go. So as Geraldine mentioned, Makita and staff collaborated to run through a lot of different modeling types as we work through the asset liability management process this year. This slide's just highlighting the full process that you've gone through already. So we're at our 4th meeting today discussing asset liability modeling. This could be the last meeting on the topic if a policy is approved, or there could be one additional meeting, and there are a few follow-up items that will come after this that we'll get to in a moment as well. If you just take a look at that timeline, you can sort of see those 4 meetings laid out. So we started looking at the process and the risks that we view. We went through capital market assumptions. Those are obviously a really key input. So now we've moved into the modeling component of this, but those inputs are really what drive a lot of the numbers that Geraldine mentioned with respect to the future risk and return expectations of the portfolio. And then as we come into today's meeting in May, we'll look at these policy options, and I'll walk through a little bit of the modeling and the process that staff and Makita took. So that really shows up here on the 3rd slide, where you see the summary of staff modeling and the recommendation that Geraldine walked through. I wanted to note that a lot of different components of modeling went into this process. So you have the traditional mean variance optimization process, where you're looking at the trade-offs between standard deviation and expected return within portfolios. Liquidity is obviously an important conversation. We'll talk a little bit about the outcome of the recommendation on policy A today, because it does change the liquidity profile of the program somewhat. There were climate models that went into place. We'll walk through some specific outputs on those in a moment. We also heard from the committee a desire to look at several geopolitical risks. So we ran each of these portfolios through those geopolitical models as well in order to better understand how these portfolios might perform in different environments that are driven by both economics, geopolitical risks, et cetera. And then finally, looking at the funding of the program over time. And as Geraldine mentioned, ensuring that we had a good handle on how that might impact contributions in the future and what various investment outcomes might mean for those contributions. So there were a lot of different models that were in place. It's been an ongoing process over the last many months. When we think about the recommendation for policy A today that staff is bringing, I wanted to highlight from Makita's perspective our confidence in the work that's gone on both on the modeling side and also in the recommendation that you have before you today. These changes are relatively modest. We think that that's prudent for a portfolio of your size. You do this process with a lot of diligence every 4 years, but making moves at the asset size you are takes considerable effort on behalf of your staff. So that implementation process is really important to consider when we walk through the asset liability modeling exercise. Geraldine mentioned that 4 options are presented to you in the longer form memo that you each have. The ask of staff and Makita was to come back with policies between 7 and 7.4% expected return. That's around where you have been to date. Staff narrowed that range to an expected return of 7.2 to 7.4. And that was, again, when thinking about the implementation impact of making changes. If you were to have shifted to a significantly lower return profile, that would have resulted in more meaningful changes to the portfolio. And we didn't feel like in a 4-year period that was likely to be prudent. So Makita concurs with staff's reflection on what an appropriate range for expected return is. Importantly, all of the portfolios presented to you today have a lower expected standard deviation, so that when we say volatility, that's the numbers that we're referring to. And so in that way, they're considered more efficient than the portfolio you have in the program today. So shifting some of that risk to illiquid assets, the direct lending program that Geraldine mentioned, leveraging the collaborative model, focusing on your move towards net zero, all of these portfolios before you, and in particular policy A, is really designed to allow you to move in that direction. So with that, from Makita's perspective, policy A is a very realistic portfolio going forward. It shifts a bit of the risk out of global equities. It does increase the illiquidity of your program, and that is a different type of risk. Everyone is aware of that. I think you've shown through your staff's implementation a lot of success investing in these areas historically, and so we're comfortable with that trade-off. But we did want to highlight that there are certain risks that you can put a specific number on, and then as we all know, there's the risk of the next 10 and 20 years, which a lot of different economic environments and other scenarios may take place. So we'll continue to evaluate those risks and come to you with any additional modeling that's necessary. With that, I was going to turn it over to my colleague Steph to walk through some of the peer analysis that we did.
Perfect. Stephanie Sorg with Makita. Good morning, all. So as part of our review of the asset allocation, we compared the current and then recommended policy A to a peer group of the 25 largest public defined benefit plans in the U.S. The peer long-term strategic policies were aggregated, and then they were configured in an interquartile spread between the highest and the lowest allocations within each of these categories. So we also wanted to take a look at how the recommended policy, as indicated by those black dots in the chart here, compared to the asset class averages in the corresponding table below. So based upon this comparison, the results showed that the recommended policy allocation to global equity is roughly 5% below the median and peer average of roughly 42%, whereas real estate, indicated by that orange column or second from the right, is 5% higher than the peer average. Private equity and then real assets and inflation hedging, which are going to be those green and tealish toned columns there, were essentially in line with those averages. And then lastly, to note fixed income, it's quite a bit lower than the average of 26 at 16%, but it is important to recognize that on the right side of the chart, we show RMS. And that recommended target is 6 percentage points higher than the average. Based upon risk return statistics, it does have a more similar profile to that of a bond investment, while also further diversifying the portfolio. On the next slide, here we go.
On the next slide here, we have Makita's geopolitical and climate simulations. So we were asked to model and essentially estimate how the current and then the recommended policies would perform during a stagflation and a geopolitical condition. Stagflation is an environment, it's defined as a decade or so of slow GDP global growth and then elongated, heightened inflation. Deglobalization, you can think of this as being similar to the economic policy shifts that happened after World War II. And so where the norms of free trade, independent central banks and democratic governments, they transitioned to trade protections, industrial subsidies, and a coordinated fiscal and monetary efforts. And so of these two, you can see in the bottom left table here, that stagflation does have, although smaller in absolute terms, a greater negative impact than deglobalization. And it does have the largest impact on the current policies. You can see in the top at 1.8% there, and that's largely due to that elevated inflation. Shifting gears to the climate modeling. So big picture here is that best practice in the industry nowadays is to model how climate risk impacts portfolios. And so before diving into the table and the results here that are at the bottom right, in this methodology and the 6 scenarios that you're seeing in the columns are provided by the Network for Greening the Financial System, or as an acronym, it's NGFS. It's an international intergovernmental organization that's made up of 121 national financial supervisory authorities, which is a mouthful, and central banks that are sharing best practices in the development of climate risk management. So these 6 scenarios that you're seeing here, moving from left to right, they simulate efforts around climate management from what you can see on the left as climate current policies, or also known as continue to operate as we do today. And then we move all the way to the right where you have net zero 2050 and divergent net zero. These columns, they illustrate scenarios of rapid immediate efforts, both coordinated and uncoordinated, that achieve net zero quite quickly. Throughout all 6 scenarios here, 2 major risk factors are in play. So we have physical risks and transition risks. Physical risks, they're essentially the risk of global warming and detrimental climate change. And then you have financial risks, which are going to be the risks and costs, or transition risks, which are the financial costs associated with changes in policy to attempt to change behavior when we're looking and working towards climate change, or mitigating it, I should say. So the way to think about these two are to essentially plot on the left-hand side physical risk, and then on the right-hand side transition risk. And so if we continue status quo with the current policies here, your physical risk is going to be at its highest. Transition risk, or the cost associated, is going to be at the lowest. As we move to the right, these start to change. Your physical risk will start to mitigate, and the transition risk will increase. I'll note as a disclaimer, it's not in a linear fashion, but that's kind of the idea as we move from left to right. So now how does this translate into an investment portfolio returns? And so without digging into the granularity of asset class sensitivities to these models here, the biggest takeaway you can get out of this and the overarching notion is that equities, both public and private, are going to be more sensitive and volatile, whereas fixed income is less volatile to climate management. And so as you can see, the current policy has the highest exposure to equities, and that's why you're seeing the widest spread in returns. And then as you go down, the equity exposure from recommended policy all the way down to policy 4 decreases, and then we see that spread narrowing. If there is anything you could take away in the last 5 minutes here, it's the fact that the range of possible outcomes across the scenarios are wide by our definition of looking in these 6 scenarios, but the differences between the 4 policy options are relatively small for any given simulation.
Great. Steve McCourt, Makita Investment Group. Just to say a few concluding remarks before we hand it back to the committee for questions. The process that CalSTRS goes through to develop its asset allocation policies every 4 years, we perceive as a best practice in the industry. And in a really positive way, that process is enhanced and elevated each time your staff goes through it. And this go around, the significant enhancements were the much more detailed modeling around economic, geopolitical risks and climate risks as well. And so that was the purpose of reviewing those results of that modeling. As you've heard from my associates here, Makita believes that the process that staff has brought in front of you today to recommend an asset allocation policy for you is prudent. We concur with staff that the recommended policy is an appropriate policy for CalSTRS to target over the next 4 years. And with that, we'll hand it back to the committee chair for any questions.
Well, thank you very much. I just want to make a personal observation. This is the most important decision the board makes, every 4 years. And I have to commend both staff and Makita for this presentation. Especially, I want to, staff has always done a terrific job in preparing us as we go down the path. And now we're at the point of adopting or a proposed asset allocation plan. But I also want to point out that Makita on this review did a terrific job of reviewing the geopolitical risks and the climate risks. And I want to commend them and thank them for their good work because I think it helps us all make a very rational, conscious decision on something that is so important. Thank you very much. So in the queue, I have Jennifer Erden. Ms. Erden.
Thank you, Mr. Chair, and thank you all for has been said. I'm prepared to support the recommendation and also as supported by Makita, including ranges around the targets. I do have one question though. Given that we're seeing these tail events that are occurring outside the expected norms more frequently, could you just give us a little bit of color around any concerns or that you may have for us to be prepared for with the recommended allocation versus current or other?
Your staff and you as a committee over time has done a very good job of recognizing the fact that financial market outcomes are not normally distributed, that the negative events that occur in the markets tend to occur more often and with more severity than would be predicted by traditional statistical modeling. The way that those risks are recognized in the asset liability modeling process is through specific scenario analysis, much like that which we did on geopolitical risk and climate. And so as part of this process, staff and Makita have evaluated each of the portfolios, not just based on the statistical mean variance risk expressed by each of the options, but also by specific tail events that may happen at some point in the future. And what we all know about tail events is that they tend to be of a different nature than one could creatively come up with in advance. Relative to your current policy, the one thing I would highlight, and Mika did so during her part of the presentation, really the significant change is a reduction in the global equity allocation and an increase in a variety of private market strategies that you'll be investing in the future. That makes a lot of sense from a risk and return perspective because generally speaking, private market assets tend to have better risk-adjusted returns over time. And you've seen that in your experience as well. As Miko alluded to, it does increase the risk of liquidity in your plan. And that's something that, while at these levels we are very comfortable with, future ALM studies will have to contemplate how much more private market allocations you could absorb without exposing the fund to significant risks of illiquidity. And you saw in the material that staff evaluated liquidity risk with this policy portfolio in a couple of different ways. The existing portfolio appears resilient to the level of illiquidity that's being recommended today. But we would certainly encourage you in future ALM cycles to put an emphasis on liquidity risk management. Final thing I want to highlight on that is, as you know, the staff has a work stream to evaluate how best to manage liquidity at the total portfolio level. So you as a committee will hear more about liquidity management from staff over the next 12 to 18 months.
Thank you.
Maybe I could make a comment on the back of what Steve was. Oh, sorry. My name is Scott Chan. I'm the Deputy CIO. And I just wanted to comment on the back of what Steve was saying. Number one, as you know, Jennifer, it's hard to predict the tail risk event. And so you have to maintain a diversified portfolio. What we're recommending is providing further diversification for the portfolio. The second thing is that we are diversifying in some areas. If you think about what's going on in the regional bank sector and the potential for the commercial real estate sector, flowing into and allocating into private credit gives us more flexibility to take advantage of what might happen after a tail risk event, right? So if you can't predict a tail risk event, you diversify your portfolio, you try to have enough liquidity to be able to rebalance, but also to take advantage of these opportunities. The second thing that I would mention, and this is one of the follow-ups, is that we're going to be approving target ranges around each of the asset classes. So we'll be asking for a little bit more flexibility around those than historically we've had. That gives us more ample opportunity to take advantage. And the third element I would say is just in emphasizing again what Steve was saying, we're building the next stage of how we manage liquidity within our total fund. And so we're going to take the opportunity to, as we hire for Geraldine's old position, the Director of Investment Strategy and Risk, put more formalized resources around balance sheet management, the ability to construct the portfolio. And so those are things that I think are going to further enhance our ability to manage through tail risks.
Thank you.
Thanks.
Can I respond also just real quick? Just, it's been brought up a lot, the liquidity risk, as it should be. And just to emphasize what you've already heard, you will be seeing in your future policies, we expect to add some more language about liquidity and how we will be reporting to you. So it will be coming back long before the next study. You will see this and all the work we've been doing, spending on this project, because we realize to move forward, we need to enhance and go to that next level. We've done a good job up to now, but how do we enhance our program and how do we put resources and really focus on the liquidity in the portfolio?
Thank you, Geraldine. Next person, Lynn Paquin.
Thank you, Mr. Chair. And thank you. I mean, this is such a heavy lift doing the ALM study every 4 years. Really appreciate all the work and the staff and Makita's work as well, too. And I had two questions. One was on the climate risk modeling. And it's difficult. I mean, we're a long-term investor as a fund, but the markets don't seem to be pricing in longer-term transition at all at this point. I'm just curious, from your perspectives, when you think that will start to occur.
Stephen McCourt at Makita. Hard to know. I would say certainly parts of the markets are pricing in parts of transition risk and physical risk, but it doesn't appear that it's fully priced in. In my best guess, just the way human nature works on lots of things, including risk, the pricing in process will happen very slowly and then all at once. And whether that all at once happens in 6 months or 6 years or 60 years is really hard to predict. So I also want to highlight, though, that financial risks in climate are really of two types, as Stephanie highlighted. The transition policy risks, which impact different sectors differently, and the physical risks that come from climate change in the future. The physical risks, as defined by the third-party data that we utilized, really start to have a negative impact looking out 30, 40, 50 years. The policy risks that affect different industries and countries have the potential to impact portfolios today and tomorrow. So not only are there two different types of climate risks, those risks have different timeframes associated with them, which also makes it challenging for the market to price them in and to weigh them against each other.
I just am really glad, though, that that was included in this year's study, as well as the geopolitical risks. I think that that really helps provide a broader picture. And then my last question was around one of the tables looking at CalSTR's current, recommended, and then peer group. And could you explain a little bit more about the leverage usage that you see at peer funds versus, and the pros and cons of that?
Yeah, in the world of larger public pension plans, today there are a handful that have, as part of their policy, an allowance to leverage their assets at the total portfolio level. And those funds have leverage targets today, generally modest ones, 5 to 10 to 15%. So it's a small minority today amongst the public funds that are utilizing leverage in their asset allocation. But it is a number that is growing slowly over time. And the much like private market allocations, which have also increased over time, leverage is an enticing tool for many plans because, at least from a modeling perspective, models tend to highlight that leverage can increase return without increasing modeled investment risk. So it's a slow growing trend, I would say, but still a very small minority of larger public plans that are using strategic policy level leverage at this point.
And some of the challenges, though, then in
challenges of leverage. Leverage is one of those things that a little bit is fine and a lot can get you into a lot of trouble. And from a policy perspective, the most important decision on leverage is where do you draw the line between a little bit and a lot? Because once you have a little bit of leverage, a lot looks better, and there's incentive to always increase it. So there's sort of a psychological risk associated with leverage. So done at low levels and done in a controlled way, leverage, the additional risk from leverage is fairly small, but at higher levels, the challenge with leverage in all types of asset classes and at the total portfolio level is that it magnifies losses. So if you have assets that go down and you're not leveraged, the more leverage that you express in a total portfolio, that loss gets magnified. The gains get magnified on the upside too, but you're essentially magnifying the investment outcome of the portfolio.
Thank you. And thank you again for the review of the study. Our office is really comfortable with the recommended option A as well, too. Thank you.
Great. Thank you, Lynn. Chairman Keeley.
Thanks, Mr. Chairman. One, I want to thank everyone who's been involved in the process, staff, the consultants, investment committee. It's been a prudent and long process, And want to recognize everyone who's been involved with the work that has brought us to this point. So that's my first comment. And I'm ready to I'm prepared to support option A as recommended. I do have a couple of questions. One, it was the last point on one of the slides that says the assumed rate of return, what we're trying to achieve with lower 30 basis points, less volatility. Is there anything that could happen in the current environment that would change that?
So the table which shows the expected return and the expected volatility of the various alternatives, including the recommended policy, are based on capital market assumptions that staff recommended and you adopted in January. Capital market assumptions, as we went through in January, are as much a function of artwork than science, to begin with. And two, they change regularly. So one of the things we caution you and all others regarding the output of these models is false precision. At some level, 10 or 20 basis points, one way or the other, doesn't represent significant change. It represents false precision in the models. It's not real information. So I think in looking at that 30 basis point reduction in risk, I think the following conclusions can be confidently made about it. Directionally, the recommended portfolio is not for certain, but most likely to have less volatility over time than the existing portfolio. The current the recommended policy will have slightly more illiquidity, slightly less liquidity than the current portfolio. And the recommended portfolio is going to have roughly the same expected return as the existing portfolio. So the numbers may change in the future, but I think those conclusions that you can draw from them would be fairly stable over time.
Thanks, Steve. And one other question. The reference to an era of stagflation. So we know how quickly the Fed has raised rates, and we're seeing now some of the implications of the velocity of increased rates. We're also in a period of relatively, seems like, slow growth, and who knows what's going to transpire in the next 6 months, let alone 6 minutes, really. No one really knows. What are the implications to the fund in the short and medium term should we enter into a period of stagflation? What is that? What are the implications of that for us?
Yeah. Generally, what it would mean is a lower expected return. Mm-hmm. So when you think about the expected returns of different portfolios that you could have and adopt, think of the investment outcomes as a normal distribution. Nobody knows the future, but you can make a reasonable estimate on what the distribution of potential future states would be. And with this portfolio, which has an expected return of 7.4%, that 7.4% represents the midpoint of all possible future scenarios, optimistic and pessimistic. If the future looks more like a stagflationary period with lower GDP growth and higher inflation, you can expect that the return outcomes for your fund will be on the left-hand side of the distribution. They'll be lower than 7.4%.
And Steve, are there, when was the last time we had a period of stagflation here in the United States?
70s. Has it been 70s, huh?
About the gap.
Yeah.
72 to 76. So it's been a long time. So what are the characteristics of that era that are being replicated currently? People must be talking about the potential of stagflation because they must be seeing some similar behaviors or an environment that's similar to 72 to 76. So what are those?
Well, the fear of inflation really comes from two elements. One, inflation that is fairly sticky, and we're seeing that in the markets today, and GDP growth rates that are lower than we're used to seeing. Why are those two events happening? That's really the broader fundamental issue. For most of the last 40 years after the 1970s, we were in a global economy where global trade increased every year. China was joining the world economy, most importantly. Increased global trade is a tailwind to GDP growth. Therefore, it's a tailwind to earnings, and it's a tailwind to capital market returns. So much of what we've experienced in our lifetimes has been a gentle tailwind that's helped capital markets because of the growing globalization in trade on GDP growth. We also, at the same time, experienced the other positive side effect of globalization, which is low inflation. We outsourced all of our jobs to people who will do them cheaper. And when you have lower inflation, bond yields go low and asset prices go up. So two tailwinds have helped the capital markets over the last 40 years. Those that believe that we're in for stagflation, more of a stagflationary environment in the future, point to the reversal of globalization and everything that's driven globalization over the last 40 years.
Thank you. Thank you, Bill.
Thanks. Yeah, we've got a lot of big items on this agenda, and so let's make it quick, Geraldine, please.
I wanted to just emphasize back to, we're talking about the numbers, going back to this is an art and a science. So the science is the numbers, but the art is we don't know, which is why historically, as those that have been on the board a long time, you see we keep increasing the diversification in our portfolio. So moving out of concentrated equities, adding more asset classes, adding RMS last time, growing RMS, now direct lending. So we are acknowledging we don't know, and the best answer really is staying diversified and increasing our diversification. Just want to underline that.
Mr. Ailman.
Really short, Bill. Stephanie, can you go back one slide? I guess just to plant a flag for the future. This is the first time we've had climate scenarios in our asset allocation. And even I don't understand. I heard definitely what Stephanie said is that the asset mix reacts pretty much the same to any of these scenarios. But I think in the future, I'd like to plant a flag that we come back to that. This would be a really rich discussion to understand for you when you think long-term, next 20 years, how these different scenarios impact this fund. So like for me, I want to understand what is that negative 70 basis points and what's the range around that in the divergent outcomes, just to expand our expectations of what could the future look like and how good it could be, but how bad it could be.
Great. A more refined review on a regular basis. Mr. Ruffino.
Thank you. Thank you, Mr. Chairman. And thank you to staff and Makita Investment Group for this excellent review and presentation. My question is really quick, and I think you addressed it during your presentation, the allocation to illiquid private investments. But can you explain why further increase in the allocation of illiquid private investment at a time when the return expectations for public assets have increased?
The short answer to that is return expectations of bonds have increased considerably, public equities have increased a little bit, and relative to your last asset allocation review 4 years ago, private market return expectations have increased somewhat as well. But largely what the model is valuing is the diversification benefit of the private market assets. So to Geraldine's point, your biggest asset class still is global equities, and therefore trimming that asset class and putting more in smaller asset classes improves the diversification of the overall portfolio.
Thank you. Thank you, Mr.
Thank you,
Chairman.
Frank. Karen Yamamoto.
Thanks for the report. There's so much information, and I've been able to benefit by talking to staff several times before even this item came up. So I really appreciate all the work that's being done. I just wanted to focus on Frank's last question about illiquidity, because that's one of my favorite things, illiquidity versus the liquidity. And I always think about, having the cash, having the funds to pay the benefits that we need to pay. And so I always focus on Chris's CIO report, cash, and then the tier 1. And so I'm finally understanding that illiquidity takes a little bit longer to turn into cash. And so, and I'm glad that we're going to have some future conversations about that. So appreciate it. Thank you.
Thank you, Karen. Any other further questions or comments? If not, I'm ready to take a motion if someone wants to make a motion. The motion has been moved and seconded. I think we have a roll call vote, please. Or do we, no, excuse me, any comments from the public?
There are no public commenters in the queue.
Okay. We can move to the roll call, please.
You don't need a roll call.
Okay. All in favor of the motion?
Aye.
We have adopted our asset allocation plan. And again, thank you. And that's it. Thank you, Karen. And thank you, staff. And thank you, Makita, for your good work. Next item on the agenda is item number 5, and it's broken down into 3 categories. Investment policy revisions. The 5A is the CIS policy revision. And so I'll call up Kirsty.
Bill?
Yeah.
Item number 4.
Oh, 4. Oh, God. I'm sorry.
As they're coming forward, this is, if you remember, and boy, to me, I had to actually ask the staff. I know I'm getting old, but it seems like a long time ago we approved the public equity move to net zero, but it was really just September. But after that, we said we'd move to the next public asset class, which is fixed income. So here they are, the next step. Then after fixed income, we'll start moving into the illiquid asset classes, which is tougher. But with that, I'm going to turn it over to Glenn and to David. Good morning.
Glenn, I'm so sorry for overlooking you.
I won't take it personally.
Oh, please.
We're good, we're good. So good morning, Glenn Hosokawa, your Director of Fixed Income, and with me is David Gold, one of your PMs in the credit portfolio. And we're here today to talk about the emission reduction recommendation for fixed income. But before we get to that, I want to kind of go over, where's the slides? This, so basically fixed income, as you know, is internally and externally managed. Roughly 80 plus, more than 85% is managed internally. And how do we manage that? We manage it on an enhanced indexing. And what is that? It's basically an active approach in a controlled environment. So it lies between passive and active. We are benchmark aware, we're not benchmark constrained. So we do follow our benchmark and we know what it is and we know where we take calculated deviations from that benchmark to try to produce positive alpha for you and the fund. We've been doing that for years. But we do it in a controlled environment. And what I mean by that is the risk that we take is mitigated, is constrained. So as you can see, the active risk range that we have set by you is 10 to 60 basis points. And we have been traveling in that area and we're well inside of that. In fact, our most recent is about 29 basis points. So why did I just spend the last 82 and a half seconds telling you about that? Is basically that's how we run the portfolio. That's how we'll continue to run the portfolio, even with this recommendation that we have on carbon emissions. So as it says, the last bullet point there is carbon emissions in the credit portfolio, which is the pie chart above are the three main slices that we run in fixed income. And the credit portfolio is 35%, and that's the area we're focusing on for this item. So with that, I'd like to hand it over to David to basically go over our thought process and recommendation.
Thank you, Glenn. David Gold, Portfolio Manager for Fixed Income Credit. What I want to do today is just describe our process and the options that we looked at to decarbonize our credit portfolios. And then I want to spend some time talking about our selection and the recommendation that we're making. Just to add to what Glenn said, I think it's important to note 90% of the credit portfolio is managed in-house on our desk with an 8-person team. I head that up. We have portfolio managers, traders, and analysts. I think most of you know that. But the efforts here to reduce carbon will be focused there. We do have 10% of the credit portfolio that's managed externally. This won't be applied to that portion in this go-round, but I just wanted to make that clear. The second part is what composes credit. Of that, 90% of it is investment grade. So think Apple, General Dynamics, Disney. We also have high yield and we have emerging market debt, both sovereign and corporate. So we're kind of busy out there, but again, most of all the carbon, if you will, the emissions are coming from our investment grade portfolio. And the charts that we'll see here is focused on the investment grade side. And admittedly, it took some time for us to get to where we are, and a lot of it was kind of circumstantial. I know the equity group did a fine job and had selected a strategy rather quickly. For us, it was a different set. And as you'll see in the chart here, and this again, this is basically the amount of risk on the horizontal axis and the carbon emission reduction on the vertical axis. You can see, and it's color-coded quite well, red, yellow, and green. And you can see that we looked at 3 different scenarios here. The first scenario was in what was available at the time. The only index out there that had low carbon was the MSCI, which is, they index, like a lot of these large providers, a lot of different assets, of course. We did take a look at their credit, USIG and high yield, vastly different. And so I'll just kind of say that just up front. So, and you can see the amount of active risk that we would be taking would be extreme. So we quickly decided not to get involved there. The next step, we were kind of mulling about what we would do and also really focusing on preserving the way Glenn described how we manage on the desk, as well as the index benchmarks that you all have assigned us to. The next step was we would basically do it ourselves. So we would actively select the high carbon emission credits and sectors and skew towards the low. That can be done, but we're adding active risk and we're taking it on ourselves on the desk, while we're also trying to manage duration and credit and the other main factoring drivers for performance. So as you can see, as you ramp up here in the yellow dots, you ramp up carbon reduction, it quickly adds risk. Well, we mulled that over and felt that that was not really appropriate. And we got quite fortunate that in the fourth quarter, Bloomberg, our index provider, created and notified us of their efforts to create a low carbon index, when you know it, of course. And so we decided to work with them with their optimization tool, which I'll talk about next. But that, of course, you can see was the best available strategy for us at that time. This chart here, describes, and I'll lead up to this in a minute, but how Bloomberg coins this is optimization. So, it's really a fancy word for the fact that they're creating a computer program that generates a low active risk and increase in reduction in carbon emissions. And as you know, for math teachers and students, you can understand that there's, they have an objective function, which is to hold active risk low, to keep the risk and return profile steady. And there are constraints to the model. And that would be, let's keep the yield within a defined parameter. Let's keep the number of securities in a defined parameter and so on. And as you can see in the chart for our investment grade bond index right now, every step up in carbon reduction, we have very little change in the index, the broad metrics. Now, of course, the composition changes. We are, of course, moving from high carbon intensity credits to low, but we're doing it on a very, very small incremental basis. And that allows us to keep the yields and the duration and so on constant. What's positive here also, it's kind of preserves the fixed income management process that Glenn described. It allows us to continue to do our asset allocation that Glenn drives, and allows our desk to continue to actively manage the portfolio and achieve some excess return that we're charged with. There is an increase in active risk for total fixed income, but the math works if credit is a third of the portfolio and we're increasing by 6 basis points active risk, then for total fixed income, it'll be 2. So it's really not a lot. It's not a lot of an increase overall. We really feel that that's something that's very attractive and comfortable for us. And finally, the thought of, you would ask, why 15%? Why not more? Because the active risk doesn't seem to ramp up all that high. And I think really there's kind of 3 reasons there. The first one is we feel it's kind of a large enough step initially that impacts emissions. Second, that it's a small enough that we can manage it on the desk. So while we will have a higher active risk because the index will change and we're not going to necessarily change our strategy out of the box, but we will then migrate back towards closer to the benchmark and reduce carbon emissions at that time. The other factor, and we haven't talked about, is the trading costs, of course, particularly in today's markets with illiquidity, the volatility in interest rates. This is a real cost factor, more to the point of our ability to generate excess returns. So if we go at 15%, the amount of trading to be done is minimized versus a higher levels. We'd expect to move maybe over the course of 1 to 2 years, and then after that, go to the 30% and so on until we get to the 50% reduction by 2030, and then the net zero 2050, of course. That's the bulk of the presentation there, and thank you.
Yeah, thank you, David. So our recommendation is the 15% low carbon optimized index. And I believe Makita has their opinion in here and they are on board with us. So we're opening up to any questions or comments.
I'd just like to have Makita, if anybody wants to say anything about this item.
Yeah, sure. Steve McCourt, Makita Investment Group. Makita worked with staff on this recommendation, provided staff feedback, and independently evaluated the recommendation in front of you. We concur with the recommendation.
Mr. Gunning.
Thank you, Mr. Chair. Just one question. David, just talk a little bit about the Bloomberg index and how it interacts with what we're trying to accomplish. I'm not sure I appreciate that.
Well, the Bloomberg index is our primary index that we utilize, of course. When I think this is what you're asking, when they themselves optimize their portfolio, there will be a decrease in the carbon emission count that MSCI data, that they're using MSCI data. We have our portfolio emissions. Of course, it doesn't matter if the index reduces carbon, it matters if we reduce the carbon. So we know exactly every bond and what the carbon number is. We have that data. The complicating factor is that at any given next year, when companies, they may increase carbon, they're likely to decrease because that's the trend in the world, and they may buy carbon credits and so on. But you know, our task is twofold. We want to continue to try to generate active, positive excess return, and then get the emissions down. We know where it lies. We know how to skew that. And I think if that's what you're asking, that's how we would, you know, actualize that.
That's good. Thank you.
Thank you.
Thank you, Mr. Chairman.
Karen Yamamoto.
Okay, hi, thank you, Mr. Chair. Thanks for the explanation. And when I was trying to think about this, as far as, does this mean that this is a starting point, as you mentioned before, and then when, after some sort of evaluation, you can see if you're going to go to 30 or 50? So is that right? It's a starting point?
Yes.
Okay.
That's correct. It's a starting point, and we just want to make sure everything is in line, that we can manage to it and what have you. And our intention is to get to 50% by 2030 and 100% before 2050.
Right, okay, I get that. Okay, so then is this a pre-approval then before the policy changes can be made, so that when the implementation can take place, is it going to be immediate, or how does that work?
So yes, it is asking for, if we are to start moving to this, as far as the implementation, when this first will happen, we'll have to rely on Bloomberg getting everything in line and us being ready to do that. But I don't know if we have to come back to the board for that, or we're just seeking approval for that.
If I could just make an observation, I think last August, the end of August at our meeting, we took the same action with regard to CIS, as I recall. Would you like to comment, Scott?
Clarify that we were asking for the approval to move 15% of the credit portfolio in fixed income, as opposed to the recommendations in CIS and global equity. This is already a modified benchmark and a small portion of that. So with this approval, we will then have staff execute that. As Glenn was saying, one of the nuances is we'll be working with Bloomberg to make sure that that modified benchmark is really, call it up to code and in an excellent quality state before we do that. Maybe that's October, maybe that's further beyond that, but this would be the only approval that is needed from the board to execute this.
Okay.
Okay, in anticipation of that. Okay, all right, thank you.
Anything else? No.
Thank you.
Great. Blake. Mr. Johnson.
Thank you, Mr. Chair. Thank you for the presentation. Quick question. You're looking at the chart under active risk and carbon emissions reduction versus CalSTRS Investing Grade Bond Index. It shows Scope 1 and Scope 2. I'm curious as to why not to include in Scope 3. I'm assuming it's based upon our actions made last September for Scope 1 and Scope 2, and if so, do the two indices that you took into account for Scope 1 and Scope 3, I mean. So does MSCI and Bloomberg also take into account Scope 3? And for the chart that was listed, why isn't Scope 3 taken into account?
Yes, so right now, all of our carbon emission count is Scope 1 and 2, and that's what companies basically emit when they have buildings and operations and produce goods and services. Scope 3 is what essentially the ancillary of what people are using their products and so on. So I think for CalSTRS, and correct me if I'm wrong, but for the total fund, we're focused on Scope 1 and 2. Scope 3 is really the combination of Scope 1 and 2. So you don't want to double count, but that's correct. Yes, it's all focused on that for all the indices for fixed income.
If I could just follow up, maybe Chris, you could follow up on this. Is there presently there is certain obligations to report Scope 1 and 2, and there's, or there is maybe it's not, Kirsty, fill in the blank here, would you
I was going to
please?
say, there's still a lot of controversy on how to do scope 3. And let me just try and give a live example, Karen. If I had a gas car, I don't, but if I did, scope 3, I would report the gasoline, the carbon from the gasoline. Let's say I had a Ford. Ford would have to also report the gasoline I had and used and burned. And wherever I bought the gas from, that company and that gas station would have to report it. So part of the problem is it almost triple or even 4 times counts the carbon emissions. The whole world hasn't even reconciled that and tried to figure out, we all want to get to scope 3, but it's just a lot of debate. Even the Europeans are debating it. So that shows you we're not there yet. And I will say that scope 1 and 2, we're getting reporting, but boy, it's still early stages. And it is still hard to get good, consistent, clean scope 1 and 2 emissions. And you know, we're on the bleeding edge of this. We're pushing Bloomberg, we're pushing MSCI to improve the reporting and get us better information, which is partly why we're, you know, these are baby steps. Even 15%, 20% is small, but that's why we're taking these steps, is because our providers are having to shift, the companies are having to think about this, so it's a gradual transition.
Kirsty, could you?
Is that fair? Where'd you go?
Could you address the issue of disclosure?
For the better. Hi, I'm Kirsty Jenkinson, Director of Sustainable Investment and Stewardship Strategies. On the Scope 3 point, you'll know, as we've addressed with Aisha and the rest of the team, this is something we're pushing very hard at from a policy angle. But at the moment, Bill, to answer your specific question, there is no requirement for any company to disclose Scope 1, Scope 2, or Scope 3 emissions. We hope the SEC ruling and the new International Sustainability Standards Board standards will enforce that reporting, particularly for Scope 1 and Scope 2. That's not under debate. There's going to be a real debate about whether there's going to be mandatory requirement on Scope 3. So if you imagine that as the very sort of framework that we're working within, it's really hard then to get the data that we need at a level that we can invest and make investment decisions on based on Scope 3. But we're trying to address that through different mechanisms, and hopefully we will get there, because that'll allow us to have a much more efficient understanding of where risk lies in the portfolio.
Now, in Europe, however, isn't there certain obligations to report scope 1 and 2?
That's a great point, Bill. Under the EU Sustainable Finance Directive and the reporting that they're having there, they are bringing in some requirements for certain companies. And again, as I say, here in the US, we don't have a global regime that allows that, but we're hoping that with the SEC and the ISSB standards, we'll move closer to mandatory scope 1 and scope 2.
Thank you very much. Thank you, staff. Chairman Kiley.
Thank you, Mr. Chairman. I'm prepared to move the staff recommendation and the accompanying memo by Makita. But before we do, I just want to be sure that I've got these numbers correct. Fixed income is 12% of the overall portfolio. 35% of the fixed income book is in credit, right? 90% of that is managed in-house by 8 people at the desk. You're recommending moving 15% of that 35%, which is 12% of the overall portfolio, using this Bloomberg index. What is the dollar amount so that my calculations in my mind are actually accurate? What is that dollar amount?
Right, so fixed income is 32 billion right now. Credit is 11, roughly. So on the desk, it's 90% of 11 is 9 and change billion.
And it's 15% of.
We're not moving money into a new index. The index is being modified to the optimization.
15% of that 9 is going to be.
Correct. So 1.3 billion.
No, we're not moving. It's not correct. I'm sorry.
No, it's fine. I think.
Yeah, I'm sorry.
It gives you.
Yeah.
We're not moving money anywhere. The Bloomberg benchmark itself is changing fractionally to reflect 15% lower carbon. So if the Bloomberg index contains 100 units of carbon emissions, it will contain 85. If our portfolio contains 100, the day we change, the index gets optimized, we will still have 100, but we will manage that down actively. Does that make sense?
It does. It makes sense. It's a great report, great descriptive, accompanying memo by Makita supporting the recommendation. And my calculations, Glenn, are roughly what the number you calculated. So
Yeah, and that
thank
dollar
you.
amount is wrong. David's correct. It's a percentage because it's not, yeah, anyway, we could talk offline.
Modifying the whole $9 billion portfolio.
Yep,
You're reducing carbon in that 9 billion.
very helpful. So I'm ready to move the staff recommendation.
Okay.
Second.
It's been moved and seconded. And Sharon, you had a question?
Yeah, just a quick, do we call that like a tilt, or what's the language we use when we say, because you say you're not moving money, which I understood that exchange, but I'm just wondering, what do we call that?
Let me just jump in.
Yeah.
I think the best way to think about it is we're changing the target. The target is now a portfolio with a 15% allocation to this piece of it, which results in roughly a 12% reduction in emissions for that credit portfolio. So think about it, the bullseye has moved to a lower carbon footprint.
And my only suggestion, Mr. Chair, perhaps, I think I had the same question, Blake, so I pulled myself out of the queue after you asked yours, is I do think it'd be helpful maybe sometime this next year, anticipating, Kirsty's presentation upcoming, it would be great to have an educational time to talk about scope 1, 2, 3, all the stuff that's happening with the ISSB and SEC. Hopefully there'll be movement at the time, but I would just respectively ask, Bill and Gail as chairing the investment, maybe a short educational session so that all board members can kind of be up to speed. There's so much exciting things happening and it's happening quickly. So at some point next year, that would be helpful, half hour or something.
Let's hope that the SEC takes our recommendation. And,
That's right.
And it will be a very educational program for all of us. Yeah. Thank you very much, Sharon. And we will follow up. There's been a motion and a second to adopt the recommendation. Are there any? Yeah.
I'm so lost in the math.
It doesn't matter. You're not voting.
I missed 2 seconds.
Okay.
Who was the second?
Oh, I thought you meant the math of Harry's math.
The math I'm not. Okay, that's what I thought.
Yeah,
Thank you.
I'm sorry. I thought you were talking about the math that Harry was talking about. We were all confused.
And the next thing is, do you have any, do you want to entertain any comments from the public?
Yeah, I was just going to ask that. So are there any comments of the public?
There are no members of the public in the queue.
Thank you for all the help. I really do appreciate it. There's been a motion and a second, and we can now have the vote, please. Do we need a roll call on this?
No.
Okay. All in favor, say aye.
Aye.
The motion passes. Thank you very much for your presentation. I think this might be an apt time just to take a no more than 10-minute break, and we'll start at 10:40 and for the next item on the agenda.
I know, but I just.
Good question, Mal. Having appeared in court too often earlier in my life, I would have loved to have had one of these. Denied. No. All right. I think now is the time that I can go to item 5. Which is broken down into 3 parts. And before me, we have the SIS policy revision first reading. And Kirsty, are you going to lead the team here for a moment or two?
I'm jumping out first because I have a mea culpa.
Okay.
We brought this to you last September, as I said. This is part of the first step to move into net zero. We moved SIS and global equity. I remember vividly at that meeting, Karen Yamamoto asked me from the dais, gee, Chris, are we going to need an investment policy change on this? And I said, no, not yet, maybe a little bit later on. Once again, Karen was right, I was wrong. To implement this properly, we need some policy changes, and I know they're technical and detailed. But this is a big shift. So with that, I'll turn it over to Kirsty, and then we'll go to global equity.
Great.
I think
Scott wants
Kirsty.
to be on the record of being right.
No. Well, good afternoon. Scott Chan, the Deputy CEO. I'm going to kick it off by providing an overall framework since there's many components to this item. And I just wanted to start off by saying what I asked the team was to really achieve two objectives. The first one, implementing the board's approved allocation of 20% to the MSCI Low Carbon Index within global equities. And number two, to simplify and create a more efficient approach to how we manage our total public equity risk. So today, we have two equity portfolios managed separately, a global equity one and a CIS one, with two risk budgets. And what we're proposing to do is to consolidate the management of risk into one total equity portfolio, including both global equity and CIS, under one umbrella. And this total equity portfolio will have a risk budget of 10 to 60 basis points and be managed by global equity. Then we want global equity, their benchmark, to reflect the board's decision of this 20% allocation to the low carbon index, starting at 10%, which is part of our implementation phase. You might be asking then what happens to CIS public equity. Essentially, it becomes an active portfolio of this total equity portfolio. Because it's purely an active portfolio of external managers, that benchmark will become a blended one. So, I want to say that, you might be asking yourself, well, why is this a more efficient and simplified way to manage the total portfolio or equity risk? It's because with two portfolios, you end up having a bit of overlap in that risk management. But when you combine the two, you're not going to duplicate or counteract the risk management between the portfolios as much. In addition, I wanted global equity and the global equity team, because they are the most effective at managing risk budgets, to manage this total portfolio equity risk on behalf of CalSTRS. So that's kind of the overarching high level. Kirsty is going to talk about CIS because there are many details that fold into this overarching framework. And then global equity, June and David will discuss those policy changes. We were hoping that unless you have a urgent burning question, to hold off questions at the end, because I think a lot of these elements come together and they work in synchronicity. So with that said, I'll hand it off to Kirsty.
Thanks, Scott. Kirsty Jenkinson, Director of Sustainable Investment and Stewardship Strategies, just to dive into the policy item in front of you for the CIS portfolio. The first slide here, as you see, is just a sort of a reminder that we have a pretty complicated policy with different elements. And so I just want to highlight that the piece we're talking about is just that little bit highlighted in red at the bottom, which is just the public portfolio. We're not talking about the stewardship policy. We're not talking about the CIS private portfolio. So just to orientate you to the fact that it's a particular part of the overall portfolio. Again, the materials that you have, the written materials and the markup of the CIS policy, it includes a number of, standardization and language cleanup. So you'll see more edits than perhaps, I'm describing here. But the 2 points we're asking for your approval of a modification of the benchmark and also a modification to removing an individual, as Scott said, CIS public portfolio risk budget. So the risk management now for the CIS public portfolio is going to be integrated into the overall total public equity risk budget and managed by June, David, and the team that you see here. Let me just go finer point. Scott talked about why we're bringing these changes to you as a sort of a package, and obviously making it, following up on the commitment to the net zero pledge that we made last year on reducing emissions in this part of the portfolio. I'll just talk a little bit about what I see, why this is a positive development from a total fund perspective, but also where it's a positive development from the specific CIS portfolio perspective as well. So I think, the first benefit from a total fund perspective is it's a very tangible step towards our net zero emissions by 2050 strategy goals. You approved the recommendation to a low carbon target index in August, but this is now the nitty-gritty sort of mechanics of how do we do it in the most prudent, efficient and effective way, and the speediest way possible as well. How do we get this started? So as you know, the current low carbon allocation sits within the CIS portfolio. Honestly, it makes the most sense for that allocation to move into global equities so that June and her team can continue to build and hit that 20% that we're targeting. So that's what's really happening here. It's another way to look at this is we're integrating these net zero considerations across the public equity portfolio, which is really exciting. I think the second benefit from a total fund perspective is that obviously the team that have the most experience and expertise in managing total active risk. That's the GE team. They're going to oversee active risk for the entire public equity portfolio under one consolidated consolidated budget. So that's great. From a CIS portfolio perspective, it's going to be different. Our portfolio is going to look very different. But it doesn't stop us focusing on what our specific mission is and what our objectives are, which are to provide additive returns to the total fund by explicitly integrating sustainability considerations, including the low carbon transition as a value driver in how we select strategies and how we select managers. So that stays exactly the same. And in many ways, I think these changes, they represent a maturation of our portfolio, a refining of our purpose within the total public equity and the total fund. It allows us to focus more tightly on, creating a sort of a tightly active sustainability-focused strategy, not least as we build out our CIS private portfolio. So all of that really works towards, I think, a natural evolution and maturation. The two changes, as you see here, and we called out, we're asking for a benchmark change. This chart shows just how different the portfolio is going to look. We're moving away from a portfolio which has a mix of diversified and concentrated strategies to one which is much more concentrated and active. As such, we need to change our benchmark to reflect and allow everybody to monitor our performance and track our performance against this change. So that's why we're asking to move to a market value-weighted blend of each of the underlying strategies, which is much more appropriate for a concentrated portfolio and a highly active portfolio. And then the second area is, as I said, the change to the active risk budget. We will no longer have within CIS our own distinct risk budget. It will be integrated into the total public equity, as you see here. I think that's a pretty good segue to hand over to June and David, who are going to talk a little bit more about what this risk budget means and how it'll affect the GE policy as well. If it's all right with you, I won't take any, unless there's a burning clarifying question. I think it might make sense, as Scott said, to move seamlessly on. Does that work, Mr. Chair? Great.
Thank you, Kirsty. I'm June Kim, your Director of Global Equity. I'm joined today by David Murphy, Portfolio Manager in Global Equity. This is actually item 5B on the agenda, to be perfectly clear, but it is very interrelated. We periodically come to the board with updates to the global equity policy, so this is a periodic update. And David's going to lead us off with the presentation, so I'll hand it over to him.
Thank you, June. Good morning, everybody. David Murphy, Portfolio Manager in Global Equity. Go to the first slide. So there are two primary policy revisions that we're proposing for your consideration. First, we'd like to add a total public equity portfolio active risk budget, as Kirsty mentioned earlier. Also, we recommend modifying the global equity policy benchmark to include a component of ACWI low carbon target. So to help frame our discussion, we just thought it would be a good idea to talk about our current structure and then our proposed structure. So let's start with the current. This is total public equity, and you'll see that it contains all public equity assets in CIS and global equity. And one thing I would like to highlight, as Kirsty mentioned before, ACWI low carbon target currently resides under CIS. You can see that total public equity does not have an active risk budget, yet the underlying portfolios do. Active risk of 50 to 250 for CIS and 10 to 50 for global equity. You'll also see that global equity, the current benchmark is custom ACWI IMI. So this is just the kind of baseline where we are now. Now, moving on to our recommendation. So after the board approved the 20% allocation to ACWI low carbon target, we had a lot of discussions and a lot of debates, right, on how to implement this. And based on these conversations, it really made sense, and this is why we're recommending it, is moving the low carbon target assets from CIS to global equity. The other thing we want to do is take the existing global equity portfolio and rename it as the core portfolio. And then moving on to active risk. As Kirsty said, CIS will no longer have a standalone active risk budget for the things that she mentioned. And their risk, along with global equity, our risk will be governed by this new total public equity risk. And we think adding this new level of risk management, it's a best practice. So this is a way we're able to measure risk across all public equity portfolios. And we recommend that this new active risk budget have a range of 10 to 60 basis points. And independently, the global equity and the risk team determined that this is an appropriate range based on historical analysis and stress testing of the portfolios. Now, for global equity, you'll notice that we are not recommending an active risk budget change since we're not going to change how we manage the portfolio. Global equity and CIS are two distinct teams with two distinct mandates. And with this new active risk budget, global equity and CIS will continue to manage their portfolios independently, but we're going to do so with a lot more increased collaboration and knowledge sharing. And finally, quickly discuss the benchmark change. So we recommend modifying the global equity policy benchmark to be based on the weights of the respective core and ACWI low carbon target portfolios. So in other words, let's say ACWI low carbon target was 10% of global equity. The new policy benchmark would be 90% ACWI IMI and 10% ACWI low carbon target. Changing this benchmark will assist with how low carbon target is implemented, and it aligns with how we actually manage the portfolio, which is really important. This will allow us to focus on alpha generation and maintain our desired risk levels in the core portfolio as we increase our allocations to low carbon target over time. So that concludes our presentation, and be happy to answer any questions.
Do you have something to add, Chris?
Just a real quick final. I know this stuff is really in the details and complicated. We have a complicated portfolio, so, but we need clear guidance under the current system. I know we're trying to simplify benchmarks, but right now, under the current system, we need guidance from you and clear policies, and that's why we're here.
I just want to make a comment, if I may. You know, we have, again, I think back to where we started. And we started with this concept of, yes, we made a pledge to net zero by 2050. And one of those comments made was that the sooner we step on the accelerator, the sooner and more likely we can get there. And it's a big challenge. Then recently, we made a commitment to get 50% to net zero by 2030. It occurs to me that, you know, and part of that plan was to use the concept of getting there across every asset class in the portfolio in a collaborative way. And this is, you know, yet a step in that direction. And also, it occurs to me that we can't get there unless we start. And the sooner we start, the better off we are. And I take it that that is why you've come here today to get this change, this policy adopted. Is that correct?
That's correct.
Great. So with that sort of framing, I'd like to have, if Makita has any thoughts on this, their thoughts.
Great. Thank you, Mr. Prezant. Makita has been engaged with both CIS and global equity staff on these changes and independently evaluated and provided feedback on the suggested changes to affect the net zero transition. So from our perspective, the policy recommendations that staff has presented to you today are recommendations that we believe effectively take that first step and move you in the right direction. I want to highlight as well that in our written material, we note that we were still considering the part of staff's recommendation that related to the benchmark change, given the greater context of benchmarks broadly that the board was reviewing. Given progress on that front, we're comfortable today also recommending that the benchmark changes be adopted.
Thank you very much. Okay, Sharon, you're up.
Yeah, thanks, Mr. Chair. And I don't know if we're planning on, you know, are we planning on taking 4A and B together and voting? Is that the plan, or one each?
I think probably it would be most expeditious to do it that way, yes.
Okay. So I support, you know, adopting both A and B that's been presented. Kirsty, I did have a question on slide 6 of that your 5A presentation. Just sort of in looking at the proposed changes, so the current benchmark to the proposed benchmark, and sort of to the, just on the face value, looking at going from more diversification to less diversification, going from maybe less active to more actively managed. You know, a general person looking at this might say, well, when you go more concentrated, less diversified, that's more risk. And then you go more active, that's more costly. And so I just wonder, can you just kind of talk about, I'm sure it's not as simple as that. So maybe just give us some flavor as to if we're making this shift to more concentrated, more actively managed, how maybe that's not the case, or.
Sure.
Yeah.
I think the main thing to think about is how this is part of an overall highly diversified total public equity portfolio. So that doesn't change. So if you think about it, what we're doing is we're moving things within, but the overall goals we have to kind of control costs and to manage risk and to diversify stay exactly the same. It's just how we manage different parts of the portfolio. So for the specific portfolio that we now look after in SIS, that will be less. It's still going to be diversified. We are still going to have managers that we will diversify themselves. We will look at geographic diversity. It's just that we won't have a large enhanced passive part of our portfolio, or an enhanced passive part. So I don't have concerns at all around our ability to manage that portfolio still in a diversified way and still to manage costs, not least because our global equity colleagues as well and the broader portfolio will achieve those. So yeah. It's very much manageable.
Yeah, this is, again, I think Kirsty's point about the risk, overall risk not changing is one. Another broader point that I wanted to make is that the risk management is now more efficient because we're consolidating the two portfolios. And where we had a little bit of duplication in the past in that risk management, now that is, we don't have that. So it's better on both those fronts, at least.
There's been a motion.
Second.
In a second. We have further questions.
I have a logistical question, Bill.
Yes, sure.
I noticed on the agenda it says first reading, so I mean, are we able to do that, Brian?
Yeah,
Okay.
we can.
I wasn't sure, because like, yeah, I guess, yeah.
No, we can do that.
Okay.
Okay.
Thanks.
Gail Miller, my co-chair.
Just on this question of risk, I think two questions. One, when we talk about risk management, I think it's important that we talk about our risk budgets, because we're measuring risk all the time. It's probably the most important thing we do here. So I do think as we get ready to present our next risk budget, I don't know if Ms. Kim, if this is where you were going in terms of talking about kind of the overall risk and how you're measuring it. I think it's just helpful to keep that in mind, that we're always updating those and updated as a part of this. I think that whenever we subsume one into another, the other question is, do we sort of lose the efficacy of our total goal for SIS in general? So if you could just speak to, I think measuring risk together is really important, but measuring outcomes, which I think to Mr. Ailman's point, which is really quite complicated right now, how we'll continue to measure the outcomes and meet the objectives of the SIS portfolio as we transition to net zero.
I'll hand over. I want to also level set. We are establishing this broader risk budget, and the recommendation is to adopt this 10 to 60 basis point at the top, public equity. So that will encompass SIS and global equity. And also, so that everybody understands, of that total public equity pie, global equity is about 96% of that portfolio, and SIS is about 4%. So we're not talking like 50-50. And this is why we can do an incremental change to broaden the risk budget to 10 to 60, even though we take in the SIS assets. From our view, it leaves global equity team to do what's kind of in our sweet spot, which is managing a largely passive portfolio within constrained risk. It leaves the SIS team to do what's their sweet spot, which is finding these very attractive and alpha adding strategies. I'll hand it over to Kirsty to address the rest of the question.
Great, yeah, thank you. I think, Ms. Miller, what I'd add to that is just, as I think about the overall SIS portfolio and our goals across both the public and private, I think that the clarity that we're being given around, how do we create value and create appropriate risk return, but in a more active way, is really important to have both sides of the portfolio thinking about this. There are many opportunities to sort of understand where alpha generation is coming from, the intersection of sustainability trends and investment. Our goal is to try and find those and to do it in an active way across both public and private. And so I see that as a consolidation of our mission across both sides of the portfolio as it grows on the private side and sort of stabilizes where it is right now, but becomes more efficient on the public side.
Maybe just to make a comment as well, that the objectives are converging as well over time. So long-term, if you think about global equities, we have an active CIS sleeve because they're new and maybe some emerging operators on that external management side. But we're seeing more and more overlap between our traditional and core global equity. And at a certain point, is it 5 years down the road, 10 years down the road, we should have one, global equity portfolio, again, with active and passive components. But that active piece of CIS will likely converge over the long term. So this is moving us into that direction as well. First on the risk side, but the objectives too.
I think that's helpful, and I think it really is such an incredible accomplishment that the teams have been able to move in this direction together. I think it's really a model for institutional funds around the world. So this is, it's slow and steady, and we still have a lot of measurement to do and a lot of objective setting, but just the willingness to incorporate all of the risk into one, I think, is a huge testament to obviously the CIS team, but really the global equities team in terms of how they're viewing the total funds. So thank you all very much.
You have a comment, Mr.?
Yeah, very, very quickly. So much of what you do creates more complexity. This is exactly the opposite. This, in fact, reduces complexity. And so it shows you when the opportunity presents itself to go in the opposite direction, the staff will take advantage of the opportunity.
Thank you, Mr. Emkin. We have one more person in the queue. Karen.
Thanks, Mr. Chair. Thanks for the report. I was focusing more, what came to mind was the monitor and reporting part of the policy changes. And it shifted some of the oversight of the individual investment managers from the board to the board consultants. So that means that we as a board will not see those gradings, I guess that we have been given because a long time ago, right? And so can you talk about what that's going to look like and what the intention is? And this tells me that it's really important that whenever we hire an investment consultant, it's going to be really important for us to know your expertise and that part of that reporting. And it's taken away some of my fiduciary responsibility or the oversight responsibility, and it's shifting to the consultant.
I'll let Steve answer the question, but we delegate a lot of our authority.
Right.
We have the ability to delegate authority, and when it's appropriate and expertise is there.
Yeah.
So, Scott, would you?
Just one clarification. I believe Karen is talking about item 5C, just so everyone is on the same page.
Is it on? I thought it was 5B, monitor and reporting.
Oh, the manager ratings.
Oh, God, okay.
You jumped ahead. Have I jumped ahead? Okay.
Yeah, okay.
Okay, sorry.
Yeah, hold that thought. We'll get back to it.
Okay.
Okay?
All right.
Any
Thank you.
questions? I didn't see it there myself. Mr. Chairman.
No, I just wanted to direct everyone, that's 5C and,
yeah.
It's okay, we're all jumping.
That's okay. So we'll go back.
Okay, thank you.
So
Sorry.
nobody else in the
Apologies.
queue. We've got a motion and a second. All in favor?
Aye.
Any opposition or abstentions?
Public comment?
Oh, public comment. I'll get this down one of these days. Public comment.
There are no members of the public in the queue.
Thank you. All right. It was moved and seconded and unanimously adopted by the board. Thank you. Thank you. Very, very good presentation. Thank you. And I want to echo Gail's comments about how well this has evolved by you guys working together. I hope you anticipate the question.
Just transfer it to the.
As the team comes forward, I really want to recognize them. I have been spending my whole life writing investment policies. I remember when STRS first wrote its investment policy in the 80s. I was not here, but I was at a neighboring fund, and the deputy CIO at the time and I wrote ours, and he wrote this one together. So I've just had a strong kinship to the STRS investment policy. This team in front of you took it, kicked me out of the door, and did an awesome job of rewriting it. This is a first reading, but it's your third first reading, as I like to tease them. But it's the first one with color stuff around it. I'm an investment geek. You guys know that. This is the prettiest investment policy I've ever seen. I love it. I'm going to frame it. But I turned it over. I just want to recognize this team. They've done a phenomenal job. I'm so impressed.
Good morning, members of the board, Chairperson Pesant. In front of you, you have the investment policy statement. We call it the IPS. As Chris mentioned, this is a modernized version of your existing policy. This team has really worked for months in putting this in front of you. This is your team. They will introduce themselves shortly. They have a brief presentation prepared for you. But before handing it off to them, I wanted to call out a couple people from investment compliance that have worked behind the scenes. So Katie Lee, thanks for all the input and keeping us organized throughout the process. And Muriel Demel for the peer research she's helped us with. And last but not least, Chris, our communications team has been instrumental in putting this colored version of the policy in front of us today. So getting away from the boring black and white old policies, very excited to bring this forward. With that, David?
Great, thank you. David Munoz, Investment Officer. I wanted to just highlight a few of the changes before you today relative to the version that you have seen in January. So just going through those really quickly. The first that I would point out is the delegation of authority section 1.4. And I just want to highlight that in the current state, the board's trading limit delegation authority extends to the CIO as well as all of the investment staff underneath that position. In the version before you today, that trade limit delegation will be consolidated to the CIO, and then the CIO can then delegate it as appropriate. I would just highlight for you that the transparency and visibility for this delegation will continue to be brought before you through our review of delegation that comes once a year to this board. Secondly, I wanted to highlight the benchmark section, and I just, there's some clarification there, but I wanted to highlight that in the modernized policy before you, all of the asset class benchmarks will now exist specifically in those respective asset class policies. Now, there are two exceptions to that, and that is cash liquidity and total public equity. Both of those benchmarks do not have a standalone policy, so they will remain in the IPS, or the modernized version that's before you today. I also wanted to mention that based on board feedback and a request from the board, that we have really enhanced our diversity, equity, and inclusion section in the modernized policy statement. And as part of that, we've added our diversity statement in there as well, in a few paragraphs describing CalSTR's commitment to DEI. There's just a few more technical cleanup items I'll mention very quickly. One is the long-term policy target implementation, that's section 1.5. Just wanted to highlight there that the board approves the implementation plan for the long-term asset allocation targets, and until those targets are achieved, the current asset mix will be reviewed and presented to the board at least annually. Secondly, with regards to portfolio rebalancing, this, you'll see more red line there than it was mostly just cleanup, moving narrative around, but wanted to point that out. The key issue there is just clarifying that the CIO has the authority to rebalance the portfolio within the allowable ranges or back into the ranges, and that any rebalancing activities would be brought before the board as well. And then finally, I would just end with that there is an investment reporting section, and we just wanted to highlight that with all of the reporting that we do to the different audiences and the different purposes of those reporting, we aggregate data differently based on those audiences. And there are cases in which reporting that we do may have various presentational differences. So with that, I'll pass it to Melissa.
Thank you. Good morning. I'm Melissa Duranco, and I'm your Associate Portfolio Manager over Investment Compliance. It's good to see you this morning. I just want to give you a little looking forward. After this policy is approved, we have created a landing page on CalSTRS.com that will house some of the important information that was living in the IPMP that is no longer physically living in the IPS, but is referenced there. And so as soon as the policy is approved, that landing page is ready to go. And you can get to it through the CalSTRS.com investment page. There's a tile on there that you can click on, or this document actually has links that will take you directly to that. And we will be bringing this policy back now that you've approved the ALM targets for the next 4 years. That update will be made in the IPS statement, and we will also be talking more about the liquidity, as you guys have had much conversation already this morning on that. There may be language changes to that section as well. With that, I think that we are ready to go ahead and answer any questions that you might have.
Sharon.
So Melissa, with your just that last comment, so are you saying that given the conversations we've had today about the asset, that you actually are going to make some tweaks to this current?
There will be tweaks because your ranges are going to be different, and we're also going to be talking about the plus or minuses as well.
And so I just want to, I feel like this is my week for mea culpas from yesterday's benefits and services. But I meant, and so I'm giving this input today just to maybe have a further conversation at some point around the human capital management piece, the 2.4 on page 16, I guess, of our board materials. And I just, and again, you are the professionals, I'm just a practitioner, if you will, and then I spend time with folks out in the world of labor. I just wondered if we could, I have some suggested ideas and language, but sort of beef up, if you will, that first paragraph to include, it reads more like how we're looking at our internal, which I know we are, we're looking at our internal CalSTRS organization. And I would love to see a little more inclusion around labor, workers' rights, kind of that angle of human capital with our partners as GPs, LPs out there in the universe. We have a lot of people in public comment, obviously, coming to talk about things like in private equity. And I think human capital doesn't just extend to our organization, but extends to the workers that that we partner with in organizations and companies that we invest in. So I'm happy to send you some, ideas and thoughts. You can take or leave, but I would love to maybe see the language broadened out a little bit more. So, yeah.
Anything further, Sharon? Chairman Kiley.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. The delegation of authority that you referenced, we obviously work under a delegated model. Can you give me an example of what will change, if anything, relative to policy, the language change in this proposed amended policy manual?
Sure. Yeah, thank you. Mr. Kelly. So I'm sorry. So the delegation of authority, actually nothing changes. So all we've done is consolidate the existing trading authority to the CIO, who can then delegate down to staff. So right now you have an actual document in the in your current policy document that highlights investment officer 1, 2, 3 in each one of their trading limit authorities. We're proposing to remove that and just leave that trading authority directly with the CIO, who can then delegate down as they see fit.
So, Mr. Kelly,
Mr. Emken.
if you
Or
think
excuse-
about the current state,
Yes.
you have a cap with the CIO.
Yes.
And that cap stays unchanged. And if we are making changes, realistically, think about the new classification, the senior director and the senior PM. The CIO can now delegate to them under that that ceiling that you will have established. So we don't have to come back to you for what is the delegation for IO1, for IO2, and so on and so forth.
What's the infrequency that those decisions come to the committee currently? Why are you suggesting that we make this change, given the fact that it's so infrequent that those decisions actually come before us?
It is very infrequent, and therefore, as we are streamlining the policy, we thought this is the best model for this board to adopt. So the decisions are very infrequent. You will still see those trade limits when we bring the delegation once a year to this board.
Right.
So I'm
That's-
trying to balance making sure that we continue in our role as an oversight committee that delegates to the professionals to be able to be as nimble as they possibly can without having an unintended consequences of us not having enough visibility and oversight. And I probably need additional conversations that don't need to be consumed by everyone else's time on this matter. Because the delegated authority that we currently have in this system, which is appropriate, is not de minimis. It's significant. And I don't want to do anything to hinder that or interrupt that. And at the same time, I want to be sure that this committee has the appropriate oversight and monitoring tools. And I know our team wants us to have that as well. And I don't understand, I don't have enough comfort level around that specific matter. And I don't think there's anything that says we have to adopt this today. I can see this easily being approved at the July offsite. And the second issue that I want to be sure that I have clarity on is, I know we've had previous discussions about the semi-annual reports and all of the managers being listed and the green, yellow, red, and that's kind of outdated now. I want to be sure that I fully understand what type of reports we will be receiving on a semi-annual or annual basis at the minimum that provides us with relevant information about who manages this capital on behalf of this trust fund, who those external managers are, especially as we're moving more and more into the private asset classes and the fund grows. It's incumbent upon this investment committee to know exactly who manages that capital, how much we pay them in fees, and what their performance is over time. And I want to be sure that I know exactly what that is, and I don't know that today. I know we want to shift to what we've been using, but I don't know what the new instrument will be.
April Wilcox, I'm sorry.
A quick point on the first issue on the
Sure.
delegation. Nikita can probably chime in, but to this board, we will say that as your investment compliance team, we have looked at all of the updates from your lens. We have tried our best to make sure that as a fiduciary, as board members, what would you like to see from a transparency perspective, from keeping the best interest of what you do. So if you think about what is being proposed, you already have delegated a cap to the CIO. Do you really want to see what's under that? It's really up to you, but we thought it may be more efficient and more streamlined to have that delegated to the CIO. So I'll
And I
let
just would add, Mr. Prasad, if I may, there is volumes of information for us to access on different places that we click on the board website, et cetera. Sometimes it's not as easy to get to and frictionless as this trustee would like. And I think that's something we have, it's there, but it's not frictionless to find it and get it.
April wanted to comment.
April Wilcox, Director of Investment Services. I just want to make sure that there was an understanding that the delegation that we're talking about in the investment policy statement are the daily trading limits for moving cash. But the delegations that are in the asset class policies on signing a new investment deal, those are going to remain. So making sure that that level of delegation is clear.
You know, does that help?
It does, yeah, it does.
Okay.
Yeah, it's all helpful.
Yeah.
It's all
great.
helpful. And we're just trying to strike the right balance.
Right.
Yeah, yeah. And so maybe I'm confused, but so we're really only talking about the amount of trades that can be delegated. Is that correct? The size of trades.
Yes, so it's like if Global Equity wants to trade a certain stock, the amount that they can trade on that one day as an IO1 versus an IO2 versus an IO3.
And that's the limit of the change.
Yes, and then the same thing for the private assets, it would be a daily cash. So how much can they wire out from a deal? But the actual signing of a new deal, we're not changing that.
Okay. Makita, do you have a comment?
Yeah. As Shafat knows, we had a similar question related to this particular item. And given the discussion that has arisen from it, my suggestion to staff is when it's brought back, maybe there's a brief presentation on exactly what activities are delegated to staff, how they're delegated, how they're governed, where does the board fit in on monitoring that delegation, how does your consultants fit in, something a little broader so that at least as you're reviewing the IPMP this time, you're fully understanding the governance and oversight and monitoring framework.
And I
that goes
think
with
that,
it.
you know, in alignment with Karen Yamamoto's comment, I think that's good advice. We want to make sure that every trustee here understands what their fiduciary duty is and whether, you know, we're within that lane. So I think that, you know, the next time you bring it back, you take in some of the suggestions that have been made here today, and also provide a little bit more, maybe graphically. So some of us who see things graphically better than understanding the words, it would help. So anyway, any other comments or suggestions? Sharon, you're up.
I love that idea, and I think my only other suggestion, it would be helpful to hear from our fiduciary council and have them opine, as well as maybe having Amy here as our board governance consultant. It just, because I hear the tension that Harry's raising, and I think that's probably a tension a lot of us feel like, yes, we're large, we want to delegate, we want to be efficient, but we have an oversight role. So that would just be my only suggestion, is to include our fiduciary council and Amy.
And then just
Sure.
two comments.
Fine.
Ms. Hendricks, pleased to let you know we did work closely with Amy throughout the process, and she has been involved and aware. And then, Mr. Keeley, your second point on investment reporting, we'll go back and look at the reporting. There are different, again, like you said, many different avenues for you to see what are the, you know, entities we do business with, and we can also take that offline and kind of walk through how to find that information.
You know, Shafat, I understand that there's been so much effort and work put into this, and we really appreciate it and would love to be able to, because it's such a beautiful report, you know, it's so well done, you know, it's you know, Pulitzer Prize winning, you know, it's terrific. But I do think that if you could come back with just, you know, a graph, you know, something pictorial that we can understand, so that everybody realizes, you know, whose responsibility it is and who's, okay? That would be great. And I promise you, this will be the, I can't promise you. I would like to promise you. I would like to promise you that we would get a consensus then, but I think today we need that. Thank you.
Just to let you know, I'm not saying that's not the right approach. There will be more changes, as Melissa mentioned, from the ALM. So we'll be coming back with a lot more changes, so.
It's a living document. It's like the Constitution. Right. We are often asked to make changes in those policies. Thank you. Any other comments, questions? Thank you very much.
Thanks so much.
Oh, Frank, I'm sorry, you just came up.
Thank you, Mr. Chair. Just real, thank you, Mr. Chair. Just real quick.
Click him in. Click him in.
You want to do this?
No,
Okay.
but I'm helping you.
I know.
Can't hear.
Briggs, and I want to not take away anything from this colorful piece. It's great work. But back to human capital management, and perhaps I want to convey the message that the treasurer really care about this particular piece. I wants to make sure that we have something in place for perhaps some labor principles that address, for example, the child labor issues that we discussed, that we all are aware of, that something that addresses that. So perhaps I want to just add the treasurer's support to your request, and perhaps we can engage our consultants or as well to help draft something, that can sort of encompasses not just the human capital management, but add some labor principles in it, gives them some teeth. That would be wonderful. Thank you, Mr. Chair.
Great. Thank you very much, and look forward to seeing you the next time.
Bill, the only reason why I had you to click on is.
Yeah, no, I understand. I apologize. I'm just trying to keep the ball rolling.
You're doing great.
Okay, item number 6, the net zero annual strategy.
Bill, as the team comes forward, I just want to make a couple of introductory short comments. I talk a lot about a marathon, and the race to net zero, I was interested, is 27 years, even though we want to be 2050 or sooner. So it kind of does mimic a marathon. Every May, we're going to stop, and that's kind of our check-in on our pace per mile. So you're going to see this on your May agenda. Hopefully we get better reporting so we can get down to the point where we can tell you, here's our carbon footprint today compared to last year, but we're not there yet. But think about that from that perspective. May is always going to be net zero month. It's a green month, so maybe that way it'll rhyme. And we're going to check in on our pace. So with that, I'll turn it over to Kirsty and Brian.
Good morning, everybody. Brian Rice. I'm a portfolio manager in the Sustainable Investments and Stewardship Strategies Group, or SIS. As Chris pointed out, this is we've established May as our annual net zero update. If you remember, when we last gave you a comprehensive update on our net zero efforts back in August, we identified a number of deliverables, action items, and we're here to give you progress on those. You've already considered a number of the action items that we told you we'd come back to you with, integrating climate scenarios into the ALM process, developing a fixed income emissions reduction plan, and then putting forward a plan to increase exposure to the low carbon target index. So this item is an information item. It's a companion item to those items. Really what I want to do is just go through some of the highlights and priorities going forward, and then turn it over to Kirsty, and she'll have some comments to make. I do want to remind you all that CalSTR's Net Zero Pledge is built on 3 pillars. One is measuring and reducing emissions. The second is growing investments in low carbon solutions. And the third is using our influence to drive net zero across global markets. I also want to remind the group that we recognize that there are things we can control, how we invest. There are things we can't control, but we can influence our efforts with companies, and that you see those constructs throughout this item. So I want to start with the emissions pillar. Back in August, we told you that the real estate group would start measuring emissions in their portfolio, and they have. They've measured, I believe, about 55% of their assets under management. So now in terms of portfolio emissions measurement, we're measuring public equity, fixed income, corporate credit, and now a big part of real estate. In terms of priorities around emissions measurement and management, certainly our priority is the emissions reductions efforts in both public equity and fixed income. The other priority is to complete the public market emissions measurement. I did want to touch on that a bit, as I think that's probably the one thing that we aren't able to deliver yet that we said we would. This is the second year that we did the measurement. So it's the first year we were able to do a year-over-year analysis. When we did that analysis, we realized there was a problem with the data. The results just didn't make sense. We took some time to went back through the process. We have identified the issue. We have identified solutions. We are working to implement the solutions. We understand the importance of measurement and doing it right from the beginning, and we didn't want to present you with data that didn't make sense. So our goal is to get this fixed as soon as possible and then come back to you with the numbers. So in terms of the investment in low carbon solutions, we told you that we would begin to grow our investment in low carbon assets. The SIS portfolio has invested $1.3 billion into low carbon solutions. Certainly think it's a highlight. We also talked to you about the challenges around measuring carbon emissions in the private markets, lack of data, inconsistent data, et cetera. And we told you we'd be looking to develop a way to better identify carbon exposure in those markets. So we've developed our green, olive, gray, GOG for short, framework. And we asked each of the private market units to look at their portfolios and to look at the assets and the investments and to assign each to one of those categories. You know, is the asset green? It's low carbon. Is it olive, transitioning? There's carbon exposure, but that can be reduced. Or is it gray? It's high carbon, and it's probably going to be high carbon. Stay that way. So I think through this, we're better able to understand carbon exposure in the private markets. And I think this will help us to help support us in terms of future investment in green and olive assets going forward. Certainly priorities here are to continue to grow investments in low carbon solutions and to really refine our green, olive, gray framework. So in terms of the influence pillar, certainly corporate engagement, the work we're doing here in SIS and the stewardship group is a big part, and it's a big focus, along with the policy work that we're doing. But we're also working with our external managers. We want them to be aligned, better aligned with the CalSTRS Net Zero Pledge. And I wanted at this point to acknowledge the work that the Risk Mitigating Strategies, or RMS team, is doing, really doing some good work, working with their managers, their peers, integrating net zero into what I think is a pretty challenging segment of the market. And then in terms of priorities, certainly it's executing on the net zero stewardship strategies that we brought to you in January. As Chris pointed out, this update will be every May. Also wanted to remind you that every January we intend to provide you an update in terms of net zero stewardship efforts as part of the broader SIS stewardship update. And so certainly we want to execute on those strategies, engaging high emitters, using our proxy votes to drive influence, and also supporting net zero policy. So there's also some parts of this item that update efforts that don't really fall into a particular pillar, but they support the net zero strategy more broadly. And I wanted to highlight the transition tracker. We talked about that back in August. We really think we need to be mindful around how the transition is happening, how it's unfolding. We certainly don't want to get behind, but we don't want to get too far ahead. And so we told you we look to develop a way to assess speed and direction of the transition. And so this is the transition tracker. The first iteration is attachment 1 to this item. We've considered the transition at a pretty high level, but the big risks that we see, the physical risk, transition risk, how policy is changing, how technologies are changing that'll impact net zero, and then finally, an emissions assessment. So if you look at the attachment, you'll see we provide a high-level assessment of each of those areas. Certainly, since this is the first iteration of the tracker, our priority going forward is to refine that, socialize it, make it more applicable. And we're also, what a priority is, we've established a net zero education program. We want to provide staff with training around priority and emerging issues relative to net zero. And our first session is in June. And Ms. Hendricks, ironically, it's about scope 1, 2, 3 emissions and carbon footprinting. So that's all of my prepared remarks. I'd like to turn it over to Kirsty Jenkinson now.
Great, thank you. I'm just going to spend a couple of moments, if you don't mind. Ms. Hendricks, I think we felt that we owed you a very direct response, sort of pulling together some of the questions that you'd asked us at the prior board meeting around a sort of set of areas. Brian's touched on them, but I thought just to be sort of, acknowledge the fact that you did ask us very distinct questions that we wanted to sort of make sure that we pulled everything together. I think the first thing you said was, how are we deepening our work to identify where in the portfolio we're exposed to the highest greenhouse gas emissions? And Brian's sort of mentioned this, but one of the comment I'd make is we're seeking more accurate measurement of emissions. We're still working a lot on estimates and data fixes, so we want to keep working. It's imperfect, but we're going to keep working on that. We're reducing our exposure to emissions in the largest portfolio, the public markets, tangible steps that we discussed today. I think it's really important to highlight how we're escalating and expanding our engagement with the highest emitting companies in the portfolio. You've heard us talk about the Climate Action 100+ sort of collaborative engagement initiative, but we're supplementing that with also something we're doing in-house ourselves with additional companies that are creating the highest emissions for the CalSTRS portfolio that we believe are sort of broadly under-engaged by the rest of the market, but still contribute significant emissions to us. There are particular companies in the chemicals, manufacturing, utilities, transportation sector that we're targeting them for very focused engagement on emissions reduction. So that's a supplemental piece for how we're going to try and really, understand where the emissions sit and how do we reduce them. I think you also asked us, where is our greatest climate risk exposure and what is the financial impact of that? I'm going to give you an imperfect answer, I'm afraid, because that is we could have a long discussion about that. I think one of the biggest challenges is because we can measure emissions, that doesn't translate to risk. Just having a static carbon footprint is not the same as understanding climate risk. The understanding of climate risk is complex and very, affects the portfolio in all different ways. I think it's been great to hear the discussion earlier, obviously, as you've hearing about the ALM. There are broad categories of physical risk and transition risk. We've been coming back to that theme. That's how we have to break down an understanding of climate risk. Physical risk affects different parts of the portfolio in different ways. Transition risk, that's if policy changes, technology changes, the business models stay the same, that affects other parts of the portfolio. But having this understanding of, data is one thing and emissions is one thing, but really risk lies with physical risk and transition risk is an area, and that's the framework we're using for that. And I do think that the work that we've done on the ALM with Makita, which has been really helpful from a macro perspective, but then also the work we're doing on a more sort of tailored asset class by asset class perspective, not least in the private markets with the GOG framework, is really trying to get to that answer, although I can't tell you exactly where it sits. It's a little bit more complex to sort of explain than that, I think. The other question you asked was, how can we as a fund be more aggressive in mitigating and managing those risks? I think, as you heard from Glenn and team, part of our approach is learning by doing. I think it's really important that our emissions reductions plans are helping us learn as we take on this new element of understanding, the investment decision-making framework that we gave you, which is how do we understand risk, return, emissions, and the impact on the funding plan. And so how can we be more aggressive? It's thinking about those four things in tandem and really doing that as we go along. And then also, how can we be more aggressive? Well, influencing the broader market, and that's where it comes from our escalating engagement strategies, our proxy voting strategies. You'll see we put a separate release out on how we're being more, we're opposing more directors at companies that we don't think that are taking appropriate steps to transition fast enough and appropriately enough. And then, as Brian mentioned, this ability to understand, risk again is how fast is the market moving versus how fast we're moving. So that's the transition tracker concept. It's like, we need to know where the market is going to pace ourselves appropriately. And it's not something we can have off the shelf, but, we're trying to use the contacts and the position that we have to give us more information on that. And I think your final question was on the opportunity side. Are we doing all that we can to invest in ways that generate returns, but also spur, this just transition to a green economy, as you so rightly called it? I think we feel in a really good position about having landscaped where the opportunities lie. I think we've spent, the last year and a half 2 years really doing that. I have a pretty good sense now across, I think, the total fund where some of the most interesting opportunities lie. And I think we've been building our internal capabilities, capacity, our relationships, our partners. I think, as you've seen witness as well, partnering much more successfully and actively across the asset classes to sort of find these opportunities. It's been really exciting to be part of that with the whole team. And obviously having the opportunity to deploy capital, some of the decisions that you've been making in the ALM to allow us to sort of lean into opportunities that we think are allowing us to, build and continue to expand these investments is really important. And so I feel really hopeful about, where we can continue to find these opportunities and how we've been set up to do it as the market starts to offer more and more. So thank you for those questions. I hope I've addressed them appropriately.
Well, thank you very much for the report. Anything further? No? Okay, I just have one quick question. Given the political tenor of some states and some regulators in those states that have looked at ESG issues negatively, and given the fact that we need to have as much data available and in cooperation with those people that we invest in, either the funds or the companies or whatever. Have you seen that impacting the ability to get information as we go looking for this data?
Interestingly, no. I think it's two very separate conversations that are going on. And one of them is a more, public relations, political communication effort. And another is the investment deployment of capital and understanding risk and return. And the two are very divergent in terms of, they have different goals. And fortunately, the political sort of PR angle is not influencing our ability to work with our partners and understand and ask the right questions about data on risk, return, and investing.
It would be fair to say that most investors in the world today acknowledge that these are risks that have to be considered in making investment decisions.
Yes.
Okay, thank you. Sharon.
Thanks, Bill. And thanks, Kirsty and team, for being responsive to those questions. I appreciate the responses. I guess it's a little bit connected to Bill's comments about data. I do think at some point we've got to figure out a way, because everything you said today, because I eat, drink, and sleep CalSTRS on this board and spend time with you and go to conferences on climate and but I still do wonder, and I know your team is already thinking about it, but I just have to say it out loud, how we think about, getting better data and metrics on how to measure emissions. Because even like the carbon footprint, I've been reading a lot about just that, even that idea of measuring our carbon footprint, it seems like it's kind of gone the way of people kind of perceive that maybe even as greenwashing at this point. And so like, what's the real metrics or data that helps show both our members, but obviously the kind of external world out there, that we are doing what we say we're doing? And I think that's the place where, again, I know we're not there because, I know there's ISSB and other places that are looking at this and moving in that direction. But I do still feel like if you're not sort of a CalSTRS nerd or a pension investment, in this world, how to tell our story out there in the world of, and I think data and, kind of metrics and measurement and percentages, and that really helps build our case. And so however we can leverage the relationships with other funds and how they're doing that, obviously we have lots of colleagues that are on the IPCC board, so I'm glad for that. But, to be able to answer some of the questions that we talked about last time, but to be able to have like data to support that, I think will help us. And I know we're headed in that direction. But does that make sense? Because I think when you say we're engaging, that's great. But what are the metrics that show us how that engagement is effective and moving us away from fossil fuels and into cleaner energy? Or that's kind of the next piece. And maybe I know a lot of other funds are talking about that too. I just think that would be helpful. I know our members would appreciate, we understand numbers and not just we're engaging. Because it kind of almost sounds like we're saying, oh, we're having conversations, but how is that actually moving the needle? And how do we have data to prove that that's moving us in the right direction? So I know we're doing that and talking about that, but I just want to say that I look forward to the day where we have kind of numbers to support what we're doing. Not that we don't have it, but just more precision, I guess, in those numbers. And Alan, did you want to add something?
Alan Emkin, Makita. I was at a conference earlier this week that was called Verde Exchange, just about environment and different ways it's being approached by the corporate sector. And your comments remind me of the fact that there are at least 20 different firms that are developing software and hardware to address this issue. There's a business opportunity, and capital is going to chase after the opportunity. When they hear comments like this, they say, great, we got something else we can sell. And so this is no different than the benchmarks, which didn't exist 5 years ago until the vendors said, we can make money selling low carbon benchmarks. And so you're creating a demand, not just you individually, but you as institutions caring about this issue. And there will be better tools, and your staff is on top of those. In fact, may well even be investing in some of the companies that are developing those tools. And that's the place where you can truly make a difference, where you're being proactive and not just measuring, but you're coming up with solutions to problems.
All right, Lynn.
Thank you, Mr. Chair. Thank you so much for the report, Kirsty and Brian, and all of the work that all the team's been doing. I think it's so exciting. You know, we started talking about this about 4 or 5 years ago, and to kind of see it year by year, kind of build upon your successes, and also the challenges that you've encountered along the way too, because I think those are also learning opportunities. We've talked a lot about the issues with lack of data, lack of disclosure reporting, and I'm just curious to see if you think there's any movement in the private equity space in disclosure and where that next push is going to come from.
Take that. And I know we have colleagues here as well who are also ready to, if we want to go into more detail, but conscious of time as well. I think there has been movement in the private equity area. The data convergence project has been something that's been put together by a number of asset managers and also asset owners. And our private equity colleagues are going to be joining that as a better understanding of how to understand, you know, key metrics around sustainability in private equity, providing that from the GP to the LP. And so I think that's a movement that we're starting to see, and that we are also seeing as beneficial for us understanding some core metrics as well. So more to be done in all areas, as we know, but I think, again, you know, there is some initial, where it used to be very focused on the public markets and in the public sort of equities area, we're starting to see, obviously, as the report we gave you showed, you know, real progress in real estate and also in private equity and infrastructure across the board for sort of, you know, standards, norms and data collection and convergence, as I say, so that people aren't asking for all little patchy bits of data. You know, we're all asking for the same. It makes it a lot more efficient. So we're seeing that in those markets as well.
You in terms of the work that you're doing?
Well, I would say it's the opportunities that we're seeing in our investment portfolio. I know Kirsty could probably go into more detail, but from my positioning, I'm seeing a lot of deals seem to be coming through, a lot of opportunities in a lot of different spaces. It's pretty exciting.
I'd say that, and just, you know, the approach that we're taking, which is the entire fund, and having the discussions that we're having internally as well as those with our partners are just at a level which is just, you know, great if you're curious and interested and want to, you know, fulfill on our mission. It feels really positive.
And it is very exciting to see all the cross-cutting collaboration and work that everybody's doing. I think that's been so positive, and we don't always see that at other investment funds.
Nope.
So thank you.
Very good. Any further questions? Any public comment on this item?
We have one public commenter. If we can get a 3-minute timer. Our first commenter will be Jason.
Hi, again, Jason Opeña-Disterhoft with Majority Action Advocacy Group working on mitigating systemic risk. I just wanted to start actually just by saying I've been working on climate for a decade. I'm still new to the pension space, and just amazed, continue to be amazed at how sort of open and transparent and responsive CalSTRS is. I mean, other public pensions as well, but CalSTRS is exemplary. And that's especially kind of interesting and important on the issue of climate. As you know, as folks have said, we're in this marathon. It's one of the challenges of our generations for the next couple of decades, and it's just all of the very transparent work that you all do is just amazing to see. I got a short course today, and just listening in on all of the details. I wanted to offer a comment just to underline, kind of applaud and underline the importance of the item around, escalating proxy voting activities in alignment with net zero goals. In general, CalSTRS is remarkably and laudably self-aware about its influence and proactive about using that influence. So just want to sort of encourage the sort of continued build out of that particular pillar. We are focused on a particular stewardship strategy, and that is director voting and holding boards accountable at climate laggard companies. Again, when we go to other institutional investors, we hold up CalSTRS policy, the sort of very clear criteria, as an example that other investors should be following. So would encourage, again, the kind of build out of those criteria. We know that every portfolio company needs to have a 2030 commitment and a 2050 commitment. So would, again, just urge CalSTRS to make that plain and continue to kind of attach proxy voting consequences to that. So thanks for the discussion. Thanks for the work.
Nothing further. This is a time for our lunch break. We will reconnoiter here at 12:45. Okay. Welcome to the resumption of the Investment Committee meeting. Our next agenda item is item number 7, Diversity in Management of Investments. Shafat and Lachey, you're right there. Perfect. Proceed.
Good afternoon.
Lachey, can you pull the mic closer to the?
Oh. Thank you. Good afternoon, Investment Committee members. Today I am joined with Shafat Hassan, Head of Investment Performance and Compliance. This is an information item as we welcome your feedback on the material. Every year, usually in the spring season, the investment branch, in collaboration with Communication, Human Resources, and Legal, publish a progress report on our diversity in the management of investment strategy. Today, we are here to share highlights of that report. To level set, I want to note that everything we do within investment branch is anchored by CalSTRS mission, core values, strategic plan, and business plan. Our strategy for diversity in the management of investments is no different. Diversity is in our DNA. We believe diversity adds value to our risk and return objectives. In fact, in 2022, Chris and Scott established the big three initiatives for the branch: collaborative model, net zero pledge, and to expand diversity across the total fund. Our diversity, can you do that? Because I'm going to forget. Our diversity in the management of investment strategy encompasses 3 core pillars as outlined on this slide. The first is internal investment branch. The second is industry and portfolio company engagement. And lastly is the portfolio management. For each of these pillars, again, we will provide an example of how we employ diversity across our portfolio. The first pillar is key as to accomplish our mission of our risk and return objectives, as approximately 45% of our AUM is managed in-house. While on this slide, we note two distinct diverse characteristics, female and ethnically diverse, to us, diversity is not limited to these two characteristics. We believe diversity of thought is beyond gender and ethnicity. We have made great progress over the years, but per the percentages noted, we recognize there is improvement needed. As such, we continue to leverage with human resources to employ practices to attract and retain diverse professionals. One method of doing this is our summer intern program, where a set of interns shadow Chris Elman, Scott Chan, and other senior leadership of our team. We believe that grooming the next generation of investment professionals is important. To date, since inception, we have hired 17 students full-time on our staff. Our second pillar, industry and portfolio company engagement. We host quite a few events that promote diversity in the industry. One that is familiar to most of us is our CalSTRS Beyond Talk. This year, we hosted an event that focused on intersectionality and male allyship. In regards to our portfolio company engagement, we belong to a group named or referred to as California Investors for Effective Board Diversity. That group makes up CalPERS, CalSTRS, LaSera, and San Francisco. And the purpose of this group is to appoint diverse individuals on companies that are headquartered in California. Our last pillar is portfolio management. CalPERS made our first capital commitment to emerging managers over 30 years ago. And while the parameters of our emerging and diverse manager requirements or minimum qualifications has changed over time, we have remained consistent and committed to this investment approach. In fact, diversity is formally established in our investment policy and management plan. We have dedicated investment programs across the various asset classes via direct or indirect relationships. We also trade with diverse-owned broker firms. In 2022, the board also, with your support, gave the guidance to staff to pursue and invest in emerging managers and diverse managers. And so by way of doing that, through various opportunities, we have participated in various events and also in order to connect with the emerging managers and diverse manager community. For more specific examples in regards to this pillar, you can refer to page 3 of attachment 2. So the takeaways here is that we are committed to emerging and diverse managers. We have diversity across our team. And also, in preparation for this report, it's pretty much a brand that is completed and done by the whole team. And now I will pass it on to Shafat to provide some governance structure as to how all these great accomplishments are taken.
All right, well, thank you, Lachey. Good afternoon, members of the board. Again, for the record, Shafat Hassan, your head of investment performance and compliance. Lachey went over all of the activities that were done throughout the year and ongoing in DIMI. And now let's take a step and look at how the staffing structure of DIMI is set up within the investment office. You've heard her say that we have been doing this for decades, and what you see on the screen is a product of evolution of DIMI over the years. Now, what I want you to do, rather than thinking of this as a hierarchy, think of it as a web with the sponsors like Chris and Scott at the very center and core of DIMI, and they're supporting all of the various activities and honestly, without executive support, we wouldn't be able to make much progress. Then you have a steering committee. It is a 9-member committee, including myself and Lachey, and senior leadership across the investment office. We come together and we set the strategic goals and priorities for DIMI. And then you also have a diversity team that is led by Lachey and includes 20+ individuals from across all of the asset classes and different areas within the investment branch. The team under Lachey's guidance and leadership is implementing the goals and priorities set by the steering committee. They share knowledge, they talk about best practices, so there is really a lot of interconnectivity across the entire branch. Now, this is the structure today, and I want to tell you why this works today for us. If you think about DIMI, and if you think about the business we're in at CalSTRS, we're not only focused internally on, setting up the best culture for diversity and inclusion, best hiring practices, but we're also in the business of allocating capital, engaging with partners across the industry, the pillars Lachey mentioned. So in order for us to be able to do this right, who better to sit at the DIMI table than all of the folks that are the closest to making these decisions, like people from the asset classes, people in the senior leadership. So although I will tell you that DIMI is not a destination for us, it's a continuous journey. So it's safe to assume that this structure is going to evolve over time as we keep up with best practices, as we make more progress. We are proud of all of the work that has been done to date, and we look forward to and are eager for the future of DIMI at CalSTRS. Back to Lachey.
Thanks, Shafat. So with that said, just lastly, we want to provide an insight on our outlook for DIMI. In July, we will present our 23-24 investment business plans, which will encompass the 3 big initiatives: collaborative model, net zero, but specifically DEI initiatives. I've been working with each of the asset classes, sort of going on road shows and suggesting initiatives, treat it as a buffet of ideas, so to speak, where they have the discretion to identify opportunities that they would like to pursue for the year. Secondly, we plan to come to the investment committee in the fall season with a work plan that will include some DEI elements and components as well. And then lastly, ongoing, we are partnering with in support of the Enterprise Onboarding Guidehouse. Guidehouse is the DEI consultant that we recently engaged that is led by Human Resources. And so the importance of this is that, as you can see, this illustrates not only our commitment to diversity and investment management, but also our accountability in that regards as well. Thank you. And with that, I will open it for questions.
Sharon.
Thank you, Mr. Chair. Thanks, Shafat and Lachey, for this presentation. I love the graphics we're using in it's very engaging to read. I just wondered do we have the kind of metrics you're offering in our investment branch, those demographics on page, 5, 6, 7, which are great. Are we creating that for our investment partners externally? Are we going to be doing some kind of reporting out on the diversity of our investment partners?
By partners, are you referring to the managers who manage capital on our behalf?
Correct.
Yes. So we actually last year, 2022, we did launch a DEI survey where we asked each of the managers in our portfolio to provide us some insight as to how our values are aligned, so to speak. And so we're assessing.
I guess our public comments.
Got ringing in my ear.
No, tinnitus. I got tinnitus. Go ahead, Lachey.
We are assessing that material, and we find that it will offer an opportunity for each of the asset classes to engage with these particular partners or managers in the future.
And that's like a self-reporting, basically. It's kind of
It's
like a voluntary
self-reporting.
self-reporting.
Yeah, and we were very pleased with the participation rate of that as well.
I know just in just the anecdotal experiences I've had, even meeting with some of our closer partners or visiting offices, you can just visually sort of go, oh, there's, 20 guys and they're having a meeting so I just wondered also, do we break it down on like C-suite level and look at diversity kind of in terms of, I noticed you did that here, like administrative support. Are we going to be able to see that in our partners?
Yes, so some of the question composed of asking the composition of their senior leadership, particularly how diverse they are, or if they have internal diversity committee, what's the diversity of individuals that are on that committee as well. And not only are we sort of engaging to find out what they're working on, which is great, but we're taking also a humble approach to perhaps learn from them as well. After reviewing some of the responses, some really great ideas that we can perhaps explore.
Excellent. Great. Thank you.
Thank you. Mr. Gunning.
Thank you, Mr. Chair. Shay, thank you. Can you just update us on what Guidehouse is doing, where they are? Just what's the status of that?
No, I'm good. I can sit right here.
All right.
Lisa Blatnick, Chief Operating Officer. So Guidehouse is the consultant that we've hired to help us align DE&I across the enterprise, as well as what investments is doing to make sure that we're doing the same things internally that we're asking of our partnerships and investments. So we just started the engagement, I will tell you. So we've got a couple of people on board, and they're starting to do developing some surveys for internal use for us to be able to respond to determine how mature we are in our program and talk through all of the things that we're already doing and figuring out what our next steps are going to be. So we're really early in the engagement, but that survey is going to be the first thing that they do to figure out whether or not what our next steps would be. So.
We did that last year with Grant Thornton, right? Is that what happened when they purchased them?
Yeah, and that was one of the reasons why it kind of has taken a slow start, is because we originally contracted with Grant Thornton. They were bought out by Guidehouse, and some of the resources were needed to be swapped. So we needed to make sure that the resources they were bringing to the engagement met our needs for sure. And so now we've got the team on board, and like I said, we're starting to meet regularly, and the survey is really the first thing that they're going to do internally to make sure that they understand the maturity of our program and what the next steps may be for us to actually gain traction on that.
What's the anticipated completion date?
I'm not quite sure on that. I know that we're doing some work. We're doing some work that I think will be shared at the July offsite. Will feed into the July offsite, but it's definitely a 2-year engagement, so it's going to take us a while to be able to figure out what kind of recommendations they're going to make and what kind of implementation plan we'll have from there.
Right. Thanks, Lisa. Thanks, Lachey.
Lynn.
Oh, thank you. Thank you, Mr. Chair.
You bet.
Thanks so much for the report, and Lachey and Shafat. It's great work. And I'm just curious, for the benefit of our stakeholders, could you talk a little bit about the upcoming Catalyst Conference? I know that CalSTRS has had a historical partnership with CalPERS, but it seems like trying to do a little bit more beyond what normally did pre-COVID, and it seems like it's going to be a very exciting event.
Sure, yes. This is, it's really exciting actually, because as you mentioned, we haven't hosted an event alongside CalPERS since COVID. So this will be our first in-person in the Bay Area. And the idea is to have, we're targeting at least 700 registrants to attend. Board members are playing a great role with speaking in regards, but the idea is to have an opportunity to connect with emerging managers and diverse managers. So it's a 2-day event where we're really kind of, the cadence is that we're learning from one another. So there's panels where GPs are kind of sharing their best practices, there's successes, there's challenges, and to be successful in this business. And then on the other end, LPs are doing the same thing as well.
Great, and will emerging and diverse managers have an opportunity to sit down one-on-one with some of the potential investors?
2 or 3 segments where managers or GPs, they can actually request to meet with allocators. And that's the great thing, because we're hoping that we'll have a great number of allocators in one room or at one conference. So that will provide, again, that connectivity for the managers to connect not only with CalPERS and CalSTRS, but more so of a group or coalition of allocators at one time.
I think it's such important work, though, that you're doing with CalPERS, and just not only attending industry-wide events and connecting through that, but actually creating a space for emerging and diverse managers to meet not only with CalSTRS team, but other investors as well, too. So thank you for doing that.
Chairman Kiley.
Thank you, Mr. Chairman. Shay, Shafat, thanks for the report. Something to maybe think about for the year ahead, working with the team and the chairman and the consultants. I like what you said. I think you said, Shay, that we're taking a humble approach and learning from some of our partners as well that are doing really great work. It might be beneficial for us at some future meeting, either through video or in person, to actually engage with some of our partners who manage capital on behalf of the trust fund, who are actually doing incredibly good work in this area, that are leading, and the ripple effect that they're able to have, especially in the private asset classes, the number of companies and chief executive officers and boards that they influence and have impact on, that I think it would be educational for us collectively to see the ripple effect that we can have and who the leaders are. I mean, sometimes we, rightfully so, highlight laggers in certain initiatives, but there are people that are doing whose values and are very much aligned with our values and whose returns reflect the type of returns we want as well. So just something for you and the team to think about.
Any other questions from the board? Hearing none. Does Makita have any comments about this presentation?
I'll be very, very brief, but I just made a note to myself, and it really, in this arena, change will not happen without your advocacy, you and your peers. It will not happen. The impediments to increasing diversity and inclusion are enormous. You have cultural biases, you have organizational biases, and absent aggressive going after this goal, it will not occur. So my hats are off to your team and to you, because it wouldn't happen without you.
Well, thank you, Alan. We appreciate that. I know staff appreciates that. And we appreciate you and all the work you're doing on this very important issue. Thank you for the report. Look forward to more. All right. Where are we? Item 8. Oh, it's the comedian's report. Our Chief Investment Officer's report.
All right, I'm going to go fast, if that's all right. We're at 307, actually where we were at the end of March. We're at 307 again here at the 1st of May. Less than like 45 trading days left in the calendar year, in the fiscal year. So it's positive, but not by a lot. The asset allocation still pretty stable. Obviously, now that you've approved a new one, we're going to start shifting it a bit. But you can see that we're already at 40% in public equity. So, you know, fixed income will increase as opportunities present themselves. I'll talk about where the Fed is. Obviously, they raised rates yesterday. Powell did not use the P word of pause, but he did imply that. Markets have been off, kind of trying to read through the scripts. You know, literally they were already saying, look at paragraph 3, line 3. That's the big key. What does he say there? So really dissecting his language. Here's the asset allocation over long time periods. And it really has been pretty stable, but you can see the growth of the pink area, which is real estate, and then the light blue, which is private equity. Those are both very large and have not shrunk, even though prices in public markets have changed. So here's a good graph. Credit to the team. We borrowed it from RFA, our real estate consultant, and they allowed us to use it, so credit to them. This is CPI all the way back into the 80s. Actually, if I squint, does it go back to the 50s? Yeah. And you can see the light gray bars, those are recessions. So, you know, recessions do happen when you have inflation spikes, but as of yet, we keep saying we're not having one. If you talk to people today on the street, they'll say we are having ones. They're all worried, but I said on TV the other day, I wonder if we're actually going to muddle along. We've been telling you we think a recession's coming since what, last August? And we have been wrong. Maybe it will happen. If it does, it's the most anticipated recession in the history of America. If it doesn't, we'll muddle along. So here's another chart from RFA that I thought was really helpful. Shows how dramatic this Fed hike has been, 0 to 500. And oh, by the way, they did go past 5%. You'll remember there was a little discussion between me and a certain fixed income person about whether they would go through 5% or not. I won. They did go through 5% yesterday. What's interesting about this is the forecast. Notice that the expectation of Wall Street is that they pause very briefly during the summer and then rates drop. I just don't get that. You know, that implies we have this little short recession and then the Fed starts easing. They have not hinted about that at all. In their dot plot, they don't even start easing until mid-late 24. So I think the street's expecting too much, but we'll see. You can see historically the forecast has been fairly spot on, but I'll point out that's, you know, kind of adjusted as it goes. So positives and negatives really have remained the same. The one I'll highlight is, you know, the question, is it a pause? Are we going to have a soft landing? Inflation is running probably at 4%. The one thing people aren't talking about, oil prices have really started to drop. Oil is down in the 60s again. And when that happens, that does take pressure off inflation. Now, China's starting back up, which is a surprise, but we're going to have to see where a barrel of crude oil goes. If it stays in the 60s, that will lighten up inflation a bit. But still, the general forecast is for inflation to be somewhere between 3 to 4%. We get the employment report tomorrow. That's going to be really key. Is employment still strong in the USA, or are we starting to see weaknesses? What we may well see is what some people described at Milken as a rolling recession. You know, tech had a lot of layoffs in the fall and the early winter. We're now seeing regional banks obviously have a crisis and a problem. Maybe it's going to be different industries at different times. So I would still use the word I gave you last time, which is a conundrum. And then with the risks that are coming up, I didn't put the risk of Russia attacking itself or pretending to attack itself. But obviously, you know, many of you are reading Ian Bremmer's stuff. The one thing I didn't put up there is, and was a huge discussion at the Milken conference, is ChatGPT and what does AI mean? You know, it has gone from, it got launched really in November. This is their Model 3 and 3.5. They already have Model 4, which apparently is for sale for subscriptions. But they're north of 100 million users. So the adoption rate is rather staggering, and everybody's thinking it will replace everybody's job. We tend to always jump to extremes when we don't understand things. So we're keeping an eye on all of these, but they are out there and risks we're going to have to live with. I'm going to encourage the public to go to calstrs.com investments. We have lots of reports there, videos, information.
galore. I am open to questions.
I'll take the liberty of asking one at the outset. And I, did not see it high on the list, if it was on the list, about the raising of the debt ceiling and how that, if it is not done in a timely manner, how it might affect the markets.
No, that's a good point, because it's really floating. We don't know when. The general consensus is the Treasury will officially run out of money somewhere in August, September. Some people have moved those forecasts even back farther because they think tax receipts are going to be pretty strong. We're already seeing them constrain. And remember last time they shut down the national parks. They shut down things that would bother the public especially. We may well get to that. My personal view is they will burn the house down to prove that it could be put on fire. But there are these negotiations, and maybe they will work to avoid it. The key is it doesn't necessarily pretend a huge crash. Remember, this happened way back, it was 2011, right? Yeah, 2011, long time ago. Treasuries actually rallied, and the market didn't mind the government being shut down. And we did get downgraded, and this time it would be a serious downgrade. But so, we're going to have to see, but it's probably a midsummer, late summer event.
Read, and I know, again, nobody can predict, but I've read as early as June that there may be an issue arise. And what I'm concerned about, and I think that a lot of people out there are, is that there is a segment of the House of Representatives that doesn't care. They have no sense of responsibility of what the outcome could be. And in the event that that were to occur, what are the downside risks that could be the result of an outcome where they didn't extend the debt ceiling in a timely way?
Well, the government will end up shutting down. They will default for the first time on an interest payment. And it would be probably Treasury bills, because bills are issued, in very short intervals. They re-auction those regularly. You would start to see if they fail, it's tough to predict exactly, but you'll see what we call long tails on Treasury auctions. Normally there's lots of bids right at the price and they sell all of it. But what they have to do is sell all of they can at one yield and then raise it a notch and raise it a notch. If they can't sell it, that has a long tail where they keep having to raise the yield to finally attract a lot of money. We used to be absolutely beholden to China. They have diversified their foreign debt holdings. They still hold a lot of U.S. debt, but it's primarily Japan first and then China. The dollar as a reserve currency around the world is still pretty locked in because of oil and things, commodities trade in dollars, but you're going to see a renewed push to change that to other currencies. The question isn't, I can't describe the number of short-term impacts, but also the long-term impacts. I have said many times to this board in the past 2 decades, we are a debtor nation. We just happen to be the best looking debtor nation. So everybody wants to own our debt. And we feel like we're a creditor, but we're not. We owe everybody else lots of money. And at some point, when you owe people money, you become their, in essence, sort of their slave. You have to come to their will. So we'll see. But right now, the dollar is strong and our credit is still good. But you're right. That's why it's not rational behavior. So I just can't predict that.
Yeah, I can predict from just watching the behavior in the last year or two that we can't count on rational behavior in these particular instances. So I see it as a significant risk. And I don't know how the portfolio reacts to something like that. And let's hope that we never have to find out. So
I would agree. The impact of going from 0 to 500 is already being felt, as we discussed, in commercial real estate. I thought RFA sent you a really good report on that. You're seeing it in the regional banks simply because their portfolios are getting hurt. Office real estate is not selling and repricing. And, the current scare with the regional banks is just simply a bear trap where people short the stocks. The minute you drive the stock down, then that worries the depositors, and then that creates, literally the entire company starts shrinking overnight, which is very hard to manage. But the Treasury has done what it can to step in. We're in a difficult slog. None of the forecasts we're reading are positive. They are either slosh along or negative. And when I say slosh along, we're 2/3 of the way into 2003. Let me just rattle off these stats, Bill. The USA is up 8% in stocks. Non-US stocks are up 11.5% in 2003 alone. Emerging markets only 3%, fixed income 3.6%. Not advertising this, Bitcoin up 77%. But digital currencies aren't volatile. So it feels bad. I know many of you have made the comment to me that things are terrible, and yet it's a positive return. Not big, not great, not 7, but we're slogging along.
Okay, thank you. Mr. Gunning.
Thank you, Mr. Chairman. I'm sorry, Chris, I couldn't resist. Space junk near Earth objects?
That was, the inevitable surprises come from a book Bill Lockyer shared with us about things that will likely happen and then be a complete shock when they do. And you've heard lately about all kinds of goofy things that have fallen. I'm not predicting, what was the movie where the satellites all collide? Gravity. But that is still a constant threat to people is near Earth objects, and NASA really does look for those.
Impacts the economy?
Depending on where it lands, yes, it would.
Learn something every day,
Remember,
right?
at the offsite, I never had lethal drones and micro drones up there, but at the offsite, Ian Bremmer said that's a serious risk unless it's regulated. So many of these, and earthquakes are a great example. We all know we're overdue to have a big one, but when we do, it's going to be a complete shock, and yes, it will hurt, it'll cause a regional recession.
Anything further, Mike?
Nope. Thank you.
All right. Gail.
Thank you, Mr. Chair. 2 points I think would be really helpful for the board to understand that I learned at Milken. One is that I think we've talked a lot about the fear of a recession, but is really, really slow growth or potential stagflation actually worse than a recession because it doesn't end as quickly? So maybe you could talk about that as a risk. The other interesting thing I think we learned a lot about was the risk of the dollar, in part because of what you were saying, and also what is a decline in the dollar mean, both for us and the fund. So I think those are sort of two pieces of potential headwinds that obviously none of this we can account for, but just in terms of the fact that a recession isn't necessarily the worst outcome for the fund right now.
Yeah. And these headwinds are strong. There are almost no tailwinds. Even though the market's up 3%, it feels like headwinds. And you're spot on. What we heard was kind of either a view that we're going to have a recession, or the other view is that we would slog along, muddle along. In other words, 4% employment is almost full employment in the USA. So strong employment, consumers kind of okay, not great. But seeing very low growth. GDP growth at 1%, 0.9%. From my experience, that's indistinguishable from feeling like a recession. The nightly news, not that anybody watches it, is they're always depressed. And so we could be in a period where the market is almost the same place next year. And that was the sensitivity at Milken, is that even though a lot had happened in the last year, they were pretty much, the market's back where it was in a year. And I wondered out loud if that could be true for the next 2 years. A recession is painful, but it happens quick. So instead of I'll use my analogy, instead of feeling poorly for months and months and months, but is it better to just be sick, get medicine, and get healthy and recover quicker? And stagflation, I've said before, you asked that of Makita, nothing does well. It is just an environment where it is hard to make money in anything. And diversification doesn't help because everything is stuck in mud. And that has happened before for periods, but the USA is usually impatient and breaks out of it. But now that the Fed has such a balance sheet, you know, they've done everything they can with monetary policy. It's up to the House of Representatives to fix the fiscal policy, and that's a pretty bad group to count on right now. And then the dollar, yeah, the issue that the dollar is a reserve currency. Look at where the dollar is trading to the British pound, to the euro, and to the yen. And then we're going to have to track that. 3/4 of our assets, almost 80% of our assets are dollar-based assets. So we do have some diversification in currency, but it's not huge.
And then just the last question around the risk we talked about for liquidity and our ability to move quickly, how you're accounting for that. Because as we are in mud, things are tighter, but there's still opportunities. So what your plan is for.
No, thanks, Gail. That is a big challenge. We have a liquidity management team that we're working on that because we're not getting the usual transactions out of private equity or out of real estate. If you remember the phrase Merger Monday, they used to on Monday announce all these mergers in activity. That was good for us because we would get distributions and money capital back, and that would help with our cash flow. That's all just been frozen since we came out of the pandemic and even in it. So we're looking at our total balance sheet, and are there ways to do short-term borrowing with banks? Are there ways to borrow against our securities? Are there ways to free up? We have liquid assets, but we don't want to sell fixed income. You just raised the allocation. With the Fed raising rates, we want to put money in fixed income. Does that force us to always have to sell stocks, or are there other ways we can finance that? So we will be coming back to you and talking to you at length in the fall about liquidity management and the number of tools we literally have at our fingertips. You brought up, I think, Lynn, you asked the question about leverage, and you noted that our peer group that Makita used had a 3% leverage. Many of the global plans in the Maple 8 in Canada, the Canadian plans, there are about 8 of them, and they call them the Maple 8, sorry. But the Australian plans, other plans are looking at ways to borrow, not aggressively, but leverage their plan a little bit so they can be more nimble when they think it's an investment opportunity. And that would be a recession scenario. We see a bottom, we want to go in and invest long. If we're slogging along, we're going to see opportunities, but you know, we have to really decide if it's worth biting on.
All right. Thank you very much for the report. Always enlightening, especially the prelim comedic course that we got. It's next item is committee work plan and input for fiscal 2023 to 2024. That will be an item that we will present at the July meeting. Gail and I will work with staff to put it together. We've got some outlines, you know, of what probably will be there in the written presentation. But if there are no questions, yes.
Just a really short comment. Harry brought it up in Lachey's report on diversity. What we're proposing, the investment committee, is study best practices on diversity, equity, and inclusion. So just like you said, Harry, bringing in some of our managers to talk to you, bringing in some of the industry associations like the CFA to talk to us. What are best practices? What are some of our peers? I have to admit, hurts me, but LA County is probably ahead of us on and really pushing the envelope on some of this. Let's learn from, I know, LA County. Yeah, I know. Don't start me talking about their sports teams. They are ahead. There are people that are ahead of us. What can we learn from them? And then obviously net zero. And I want to put a placeholder for maybe 2024, 25. That sounds so far out there. But, you know, with the discussion yesterday about simple benchmarks, I think that really the investment committee needs to talk about that and think that through. And how can we meet your desires in that area? And that in the work plan, their meetings are really pretty full agendas, as you felt, but we have a couple of meetings where we can do some work plan stuff. So we can't do a ton of things, but your time and attention is important, and I think that's a major issue you do want to spend time on.
Thank you very much, Chris. The next item on the agenda is the consent agenda action, the Investment Committee Charter Review. The staff has recommended, this is a consent action, obviously, that the charter is, be left alone as is with no edits. Do we have any objection to that? Hearing no objections, can I have a vote? All in favor? Your consent, yeah. Okay, that's right. What am I saying? It's consent. We're moving down. Review of information, approval of the minutes of the March 2nd, 2023 meeting.
Move.
Moved and seconded. All in favor? Any opposition or abstentions? Adopted. Okay, review of information requests.
I have nothing of note other than a couple of things I just want to clarify. On item 4, there was a discussion about coming back maybe for some education sessions on the scoping, 1 through 3. And then in item 7, engage with partners who manage money for the fund who are doing great work in the area of DEI and get their input. Those are the 2 notes I had. I'm not sure they were technically information
Yeah,
items.
thank you. Thank you. Well, with that, I think we have the draft agenda for the next meeting, which is item, I'm sorry. Oh, I didn't see it. I saw.
I just wanted to clarify Alex's input and Madam Vice Chair and Chair of Investments for the work plan next year. I think beyond the scope 1, 2, and 3, I think it was just a general kind of educational piece around what's happening with disclosure and ISSB and potential benchmarks on measuring ESG. So however you guys see fit for next year to put something like that together, because so beyond the scope of just 1, 2, and 3. So thank you.
Great, thank you.
Yep.
Sorry, I missed it. Okay, we've got the agenda, proposed agenda for our next meeting, which is item number 13, I think. Yeah, the draft agenda for the September 2023 meeting. Any additions or suggestions? Okay.
So if I can just add really quick, we'll bring the investment policy statement back there unless there's room on the July agenda. But that's an offsite, and we'll see, that's mostly the retirement board. So that would be back, and as always, I emphasize September and March are really big meetings because those are your semi-annual performance report. September matters a lot because that's your June 30 number. And you get a very thick report, very detailed report on all the managers and how they're doing, every single one of them. So I realize now everything is digital, so you don't retain copies of that stuff, and it makes a big difference. But Makita will go into that, and they will review how we're reviewing the managers. That's included in that report.
Great.
So
Great, thank you.
Do we have a location for that, the September meeting?
Well, the September meeting's here.
It is here.
Yeah, the offsite is in Southern California. Yeah. Okay, well, thank you very much for everyone who participated in the general meeting today. What I would propose is that we take maybe resume in this room as opposed to the other room in the back there for the closed session. And so you can take maybe 5 minutes and we'll be back to deal with the closed session agenda. Thank you.
This is.